Download today.
I want to play a game. It's a relationship game. So I'm going to ask you each a question.
Who loves the hardest?
Yes, yes, yes. So are you ready? Who's more stubborn? Who's more public? Who's more patient?
These are two of the least. These are the least patient people I've ever met.
I'm going to say him just because he's a little older than me.
Who calls or texts more? And who do you think takes longer to get ready in the morning? Who's a better driver?
I drove a truck in New York City.
I can fly an airplane.
Who loves the Fed the most? Who's the bigger spender, do you think?
Me. Yeah.
Who's the alpha in this relationship? Who is more spoiled?
Oh, him.
Who do you think is funnier? Who is the better debater?
I'm gonna give it to him.
Dylan, you think you're the better debater? Are you the master debater?
No, he's good because he doesn't answer the questions, which is great for debating.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
What downgrade? It's Monday, May 19th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan. I take you through the rest of this hour. Futures market closes at 5 p.m. Eastern. If you're joining us on the platform on tastylive.com, welcome. Thanks for coming. Otherwise, join us on the YouTube platform, come over, join the chat. Tell us what you're trading here today. What you think of this market reversal where, for all the warts of this morning's news of U.S. debt downgrade over the weekend, stocks closed a little bit above Friday's highs. S&P 500 up by 0.09%, NASDAQ up by 0.06%, the Russell shade weaker down by 0.47%, the Dow up by 0.34%. Bonds staged a pretty meaningful rally over the course of the session. Gold's able to hold on to most of its gains. The dollar slightly weaker, although it does bounce back. Moodys, thanks for telling us all something that we knew, that we're spending a lot of money here in the U.S., and we're not really taking any steps to addressing it. That's the news of the weekend, though. Putin and Trump talk today. Of course, this is a week where Fed speakers dot the calendar, although I don't think anyone cares what they have to say. Dylan, you're feeling awfully optimistic here. Is today's price action where stocks fade the entire downgrade effort, is that part of the reason why you're so bullish?
I mean, it's validation of the bullishness that we were talking about last week. It's like exhibit number 977, 433,000. You know, I mean, the fact that the downgrade can happen, which there has been may have been some point in time, somewhere, someplace where it mattered, but it doesn't matter. And it's the latest thing that doesn't matter. The Trump tariffs don't matter. The threat of a recession doesn't matter. You know, Ilya is going to say it doesn't matter until it does, which is also true.
That, and I don't think this one should have mattered. And so
you don't think the credit downgrade was a worthy?
Yeah, I don't think this one should have mattered.
Negative.
So I don't really look at the absence of a negative response to this.
Well, what about the tariffs and the recession?
Well, the tariffs are apparently on some sort of a new cliffhanger, right? So July 8th is the first round, and early August, I think August 12th, if memory serves, is the China cliffhanger. So we're basically going to wait until the next episode in the series, I guess, unless somebody decides
And
to
ignore it until
tweet
then,
something.
basically.
But this is where I think it gets interesting, is like all of this has been about the drama, especially since the beginning of April. But the growth data is steadily deteriorating. The question is, do the markets decide to care, and when? So, not yet. They cared in mid-February because that's why they started to sell off. There was a growth scare. Then it became something much more scary and hysterical, and now obviously that part of it is over. They've unclenched fully. Will they start to care about growth now? We'll see. There's some interesting data this week, but there's not a lot of it, and it's all late in the week. And maybe that's part of this. Maybe the markets get a chance to find a default.
Look at this vol compression that Chris just brought up. I mean, if that doesn't tell you that the market is off and away.
And it's compressed, interestingly, not all the way back to the lows, though, of course, doing technical analysis on VIX is a fool's errand. But it's compressed right to where the growth scare sort of starts to really bite. So now you have to ask the question, okay, we've reset across markets. The only market that sort of really stands out as where you haven't is the dollar, which is sort of encouraging to the idea that all of this unclenches in a growth scare. But when? Not yet.
Not yet. I mean, Ilya, there's part of me that thinks what happened to bonds after the 2011 downgrade? They rallied. What happens to gold? It rallies. What happens to stocks? They actually settle higher at the end of that week. the Dow Jones has 4 or 5% swings in a row. Mm-hmm. Down 5, up 5, down 5, up 5, and then kind of just peters out into a gain. And while there's turbulence over the next few months, the market finds its low in October of that year temporarily.
It almost seems like we did all of that today, basically.
We speed ran the entire month and a half reaction. I would, Dylan, maybe it's just my memory here, or maybe I'm memory holding it. Apparently, Fitch Ratings downgraded us in 2023.
Yeah.
I don't recall that being of consequence itself. Dylan, do you think the fact that we now have fully lost our AAA rating across all 3 major agencies is a problem, or I don't know?
I think it's one of those things. That the short answer is no, but I do think that it's one of those things that in some intermediate or distant future, if the United States does not find some other way of existing, meaning fiscally, that people will look back and they'll be like, oh yeah, they've lost their AAA rating in 2025, and then whatever, this happened in 2035 or something, or 2075. But in the era, in the world of now, it obviously doesn't matter.
Doesn't matter.
It's a marker retrospectively.
Dylan,
it just seems like it shouldn't matter. I mean,
it should matter,
Chris.
No, it should matter. It doesn't matter, and I think that's part of the problem.
It shouldn't matter in this sense. Of course, it should matter that borrowers are expected to pay back or aren't, and it does matter. We saw it matter with Greece, sort of famously. We just saw it matter with the UK with the Liz Truss situation. Obviously, it matters. But it matters if there is a legitimate threat and if the rating actually matches what is reality. It is not logical to say that the U.S. is not the most eligible borrower in the world. And if the rating isn't relative to who is the most eligible borrower, then what does it mean? The question isn't, is the U.S. facing a fiscal difficulty? The Fed's been talking about it. Everybody's been talking about it for years. That much is clear. The question is, who's AAA? That is, who is the most eligible borrower? Is there any doubt that that's the U.S.?
No.
Okay. So what do we even say?
No, I mean, I think it should matter insofar as I think it would be good if we had an objective, nonpartisan, completely unbiased group of individuals whose discretion and job was to provide unbiased analysis about the state of government credit ratings. The reality is that these are issuer-paid ratings, and there is capture here, very much like there's capture in 2007, 2008, where the rating agencies don't want to lose any clients, so they continue to just whistle past the graveyard. You shove enough crap into a mortgage-backed security, the diversification makes it AAA rated. It doesn't matter that all the bonds are BB rated in there. The fact that there's a whole bunch of them means it's diversified. Dylan, I mean, I think of your rant all the years ago, the famous Dylan Radigan rant that people can look up on TV about how institutions are broken, completely captured by a system that doesn't help the American people. The rating agencies are part and parcel to that.
Central.
They are supposed to be the people.
They facilitate the corporate bond market and the mortgage market. I mean, they facilitate the leverage.
Right. And so the fact that you're getting, when did U.S. If we want to say that this is a legitimate problem and we think that there's a problem in spending and taxation in the United States, when did we go off the rails? When should the rating agencies started to have act? You could argue it's when Medicare Part D expansion passed in the 2000s, right? When we give up the Clinton level surpluses and then we start to go down into let's spend more money than we actually have. The Iraq War, digging out of global financial crisis, yada, yada, yada. So telling us this in 2025, after we've accrued $36 trillion in debt and have run deficits for decades in a row now, what information edge does that provide anyone? How does that help anyone at this point in time?
I mean, the problem with the rating agencies now, like when you see them, especially when they do a sovereign like America, I see that and I feel like it's a reflection of the rating agency trying to posture or position its own relationship with its own self-perception of its external reputation, if that's not too convoluted a thought, that it actually has nothing to do with the credit of anything, and it has everything to do with their desire to project themselves as authoritative or credible in some way, and that they make decisions based on not the creditworthiness of a given fixed income entity or asset or country or whatever, but rather based on their perception of what is most valuable to support their reputation, knowing that they're a captured regulator, if you will, who's paid by the very people that they rate.
Which precisely explains to you why, if AAA is some nebulous concept, rather than a relative grade of who is the most eligible out to who is the least eligible, then the object of the game is to protect the sanctity of this arbitrary yardstick. And that doesn't help anybody in practice. Because what matters
but
is
it also, I think,
actual
explains
credit
why
risk.
it doesn't matter. I think it also
That's
is
right.
the answer to the question as to why it doesn't matter.
That's exactly
like to your
right.
point, Chris, it should matter.
It should matter, yes.
There should be an independent, point of view or whatever rating on creditworthiness, but it doesn't exist, which was one of the many revelations of 2009 and 2008.
Don't, I mean, like the political polarization thing to me, it's like, yeah, really?
I mean, you could even go so far as to speculate that Moodys just doesn't like Trump.
No, but I mean, honestly, like what's been triggered? That there's been no change in law. There's rumors of a potential deal going through, although given the consternation from the SALT caucus is what they're calling themselves versus everyone else who doesn't live in a blue state. There could be a big expansion of the government debt and deficits moving forward, but by no means it's a fait accompli. If anything, I think Moody's just gave all the deficit hawks some ammunition, right? The people are holding the line saying, like President Trump, we're spending way too much money. This is not the promise that we were elected on. We were promised to cut spending, right? Now they have this rating agency downgrade at their, wind at their back, and they could say, see, like everyone else thinks it's a promise, not just my ideology that tells me it's an issue. Maybe that's one of the reasons why the market's so stable today. Instead of embarking on a fiscal policy that would probably be inflationary, right? Deficits approach 10%. If you thought the 7% debt to GDP ratios that we had under Biden were outrageous, highest that we've had outside of wartime era, the current legislation as it's proposed would bring them to about 10%. So that's going to increase the government spending net. And so maybe this gives the hawks something to lean on and prevents actually a bill of this stature, $6.2 trillion in new debts, including the interest payments over the next 10 years. But Fitch, like telling us that the country's polarized. I don't know what that does.
Yeah, but that's why I think it's all in reference to themselves. Like I don't think it's a value to them. I think it's in value to the ratings agency's perception of themselves.
Could we raise money? Yes. Can we print our own currency? Yes. We try everything else except for raising taxes around here. So, I mean, if you raise taxes and cut spending enough, could you pay off the debt? Yeah. Do we have assets in the country? Right. This is one of the unique things.
This is the thing that drives me nuts about the whole thing. It's like
the private sector is what gives the government its credibility, right? That's the tax base from which. So yes. Are you suggesting that all U.S. companies, the private sector here is also not as valuable moving forward? The government's not going to be able to tax it if it needs to moving forward?
Let's just consider for a second just the land. Just the value of the land that the government owns. Like, let's talk about securing borrowing but with collateral. Like, if I'm a billionaire but I haven't worked in 2 years because I've been sitting in a hammock in Bali somewhere, but then I decide to walk into a car dealership and say, I want a no money down, low interest rate loan on a car. Am I going to be denied? No, because it's my asset base that's going to matter, not whether I worked last year and what my income was. It'll be my ability to pay. Who sits on the absolutely biggest, most valuable asset base as a sovereign? This is not a conversation. This is obvious. So the idea that the AAA rating is an ideal rather than a reflection of who's the most eligible borrower makes it practically useless.
Practically useless. A day like today where the market does bounce back a little bit after this harrowing U.S. credit downgrade news. Gold is your top performing sector among the equity sectors. GDXJ lead to the upside. It is a more defensive kind of day, though, so I don't want to say that this was all roses on the way to a green candle here as we make our way through the session. XLV, XLU, healthcare, utilities, and then staples, XLP, among the winners here in this session. There's only about 12 ETFs of the 15 that we track that are in the green here, and names in the red are like your XLK, your XLY, your XRT. So it's not a perfect kind of session where we bounce back and it's the growth stuff leading the way higher. It's also not a terrible day here, Ilya. I mean, did we learn anything at the end of the session? You always say the market cares about something and something matters insofar as the market cares about it. So yes. The ratings downgrade today, right, categorically different than what we see in 2011. 2011, we wake up Monday morning, the Dow's down 5% on the close. And then Tuesday, it's up 5%. Sure. And then Wednesday, it's down 5%. And then Thursday, it's up 5%. And then we kind of just all chill out. Mm-hmm. Today, we just chill out right away. I couldn't even tell you. I mean, maybe it's a knock on me and I'm kind of outing myself here. I couldn't tell you what happened the day of the Fitch rating. I have no idea what happened. I don't remember at all.
I remember having a similar conversation around the desk saying, look, this doesn't matter. You can't downgrade the world's most eligible borrower. That makes you look dumb. The problem in that equation isn't the borrower, it's you.
What happened to S&P Global after it downgraded the U.S. in 2011? Stock market rebounded by the end of the month, by the end of August that year. But in August 2011, S&P Global was still off by, I think, 7%. Right? Like people
the general consensus was
these people are idiots.
This is ridiculous. This is ridiculous.
The market decided that the collective experience of U.S. equities was not weaker because of a perceived credit rating downgrade. It was that the people who would approve such a measure from S&P Global fundamentally do not understand how the world's economic system works.
Right.
They don't understand what it means to be the world's reserve currency. And if it was political
to be the issuer of its risk-free asset internationally.
Yeah. So is there political polarization? Yes. Should we do more to get our debt and deficits in check? Perhaps. I think so.
Yes, of course.
But this doesn't matter. It doesn't matter that it happened under Obama, and it seems scary because it was the first time. It didn't matter that it happened under Biden. I completely forgot it happened under Biden. I think that in a week's time, after Memorial Day, Dylan, I don't think we're going to talk about this.
I mean, I don't know if you're going to talk about it tomorrow.
Oh, challenge accepted. Let's not talk about the ratings downgrade anymore because it really, I mean, what are you telling us that we don't know? And I still have the global financial crisis, Dylan, of all the rating agencies, the same rating agencies, by the way, telling us that all these products were okay, that we were okay to trade them, okay to buy them, and that the banks were okay. There was no risk there. And sure enough, they just didn't want to lose the business.
But I mean, I think the ratings agencies with the I would say with the more the upper end of the information curve in terms of people knowing what happened or more about what happened in 2008 and 2009. I believe that the ratings agencies basically lost a huge amount of their overall credibility permanently.
Yes.
Permanently. And so I think that the fact that whatever it is, I don't know how many years it's been, 15 or 16 years, and the ratings agencies can do something like again, a downgrade, to your point, Chris, a downgrade of America's credit should matter. And I believe the reason it doesn't matter is because for the reasons we've discussed, which is that the ratings agencies proved that they are not an objective judge of creditworthiness, but they are a regulatory stamp of approval that can be purchased.
Yes.
And that's a different thing.
A self-appointed regulatory stamp of approval, which, by the way, they're willing to overlook your problems if you give them enough money. That's what history told us in 2007, 2008, 2009.
And a lot of people learned that. Sorry, go ahead, Elliot.
Yeah, I mean, just let's give them due credit, right? Institutions do. Well, hold on.
You have me out here defending the Trump administration, Elliot. You must know how low on the totem pole rating agencies are in my book.
So let's give them due credit. Institutions do change. No. Well, hold on. Institutions do change. But when you go and you downgrade the U.S., that tells us you've learned nothing. And you don't want to change. And so we shouldn't care.
If you're going to downgrade the U.S., you have to downgrade everyone else too.
This is
all the companies, exactly. All the businesses, all the people,
exactly.
All of our trade partners.
Exactly. So I don't want to say that they're not credible because they bungled what happened in 2008. They had ample time to change. They could have done that. That we're seeing a downgrade of the U.S. today tells me they have not. And there's no reason to think that this is Moodys now. Obviously, maybe things have changed at S&P, or you haven't seen them downgrade again. Maybe things have changed at Fitch since 2 years ago. Who knows? Doubtful. What this tells you is they had their time to change, and they're not credible today. Not because of what they screwed up then, because of what they are screwing up now. And there's no reason to care.
Here's a future headline for everyone to trade around. When we say that these companies are issue or pay, I mean, literally what it means is that they go to a country, a sovereign, right, or a business and say, you want to have access to this market, you want to behave in this capacity in financial markets. Our rating helps provide a glimpse into your financials, tells the world your worthiness from a balance sheet perspective. It's a shortcut. You pay us, we give you a rating. Makes life easier for you. I wouldn't call it a mob racket, but the point is that you have to solicit these ratings. The rating agencies may do unsolicited rating activity, but we as the United States actually pay for our rating. We solicit the rating from these agencies.
And then the rating is even worse. Even worse, the rating is then used as a filter for institutional asset managers, state pensions, the teacher's pension, the fireman's pension. I get they have the bylaws, as we all know, where it's like, well, you can't buy anything above a triple B and blah, blah, bullshit. So the whole thing, I mean, it's a racket. It's a racket.
I think I see what Chris is going here.
Well, it's a risk-shedding racket because then the fund manager could say, it wasn't my fault we lost money. I did what the bylaws said and didn't buy anything less than triple B. I mean, the whole thing is a way to move liability away from each other, basically. Everybody's trying to make sure that whatever happens, if I lose money as a fund manager, whatever it is, there's no legal liabilities with whatever happens, basically. The ratings agencies are like a giant liability shield.
That is in part why they exist, but I'm looking forward to the future headline of when Trump announces that we're no longer soliciting ratings for many of these companies. And that's going to produce a market sell-off, of course. But again, who cares what any of these people think?
But then we might magically become AAA.
That's going to be funny how that works.
Because if we can accept jets, then we can buy.
Well, now, or Trump could start his own rating agency and just give the country a AAA.
That's it.
It's not hard.
A triple T, if you will.
Trump could just be like, it's a AAA. There, next. He'd just say it like a king.
I think that this is we're going to hear about this again in the future, but it's not. For one, Elliot, I think you're being awfully generous by saying that institutions like this can change. They are still issue or pay models.
Now, in his defense, he said
I have to be open-minded to the possibility that they can, and to then look at the evidence now to say, nope.
If you want to be open-minded, go to the recommended For You tab on YouTube.
That much stronger.
If you want to be open-minded, go to the For You recommended tab on YouTube. Okay. Go have your spice of life in there. Do not bring that shit about rating agencies to this chat.
I think their failure to understand that you can't downgrade, and not there. Let's keep it to Moodys. They did this. S&P hasn't done anything since the 2011 thing, and man, did they get heat for it. But if you're gonna do this now, that's more glaring than if you did this back when S&P, say, did it. Because S&P did it relatively quickly after the 2008 crisis. Their reputation was in tatters.
But they did it amidst the debt ceiling negotiations over the summer of 2011, right? Like there was a
and the Eurozone debt crisis.
We were talking about the U.S. breaching the debt limit and defaulting and then kicking the can down the road, right? So it's like, okay, like there was where is that right now? What's the springboard for?
Exactly. That you're doing this in 2025, even if we are generous enough to give you grace to learn in 15 years, if you're still doing this in 2025, that's more damning.
It's kind of like
you should know better.
It's like an analyst who comes out before, like you have all your ratings going into an earnings release, and if you come out and change your buy, hold, sell rating right before an earnings release, people are going to think that you know something, right? And if you're wrong, you're just going to look like an idiot. No one's going to trust you anymore. They're gonna think you have bad judgment. So I don't know. I'm worked up about this only insofar as it seems like should be something that matters. These rating agencies have completely new to themselves, and I suppose this outs me as an institutionalist. I believe in strong institutions. I think all the institutions around us and in so many forms and function of life have failed, Dylan, right? And the reason why you have populist nationalism on the up and up in a lot of the West is because institutions have by and large failed. And that does not just mean government institutions. That means pillars of the private sector that are supposed to be kind of the referees that make sure the game's being played fairly, that everyone has a fair shake. Turns out that they're just on the sly like everyone else, right? Like, if you told me that Moodys was out here.
I believe all of this is why Donald Trump is the president of the United States.
100%. I mean, if you told me that Moodys was out here collecting PPP loans or got USAID funding, I wouldn't shock me, because apparently everyone's on the take except for us three. Right? Like, the overtime boys, we didn't get PPP funding. What was that about? We didn't get USAID funding. But I bet you Moodys did. Okay. That's obviously said in jest. Please don't sue us. NASDAQ here, 21,527 today. Ilya, that is a bullish engulfing bar to give this a little bit less of a vamping, shooting the shit vibe and more of a technical vibe here. The high from Friday is 21,512, so we do clear and close through there. We're a little bit softer here after hours. What do we make of this price action right now? I mean, Tony was saying it before, 7 days up in a row. That's not nothing. That doesn't happen that often. Typically, rallies of this form and function, like they did back at the end of April, 9 days up in a row, 80% of the time they're occurring in bear markets. And yet we're closer to the highs of the year, arguably, than we were to the start of the month. So what's the next move here for stocks this week? Meandering, steady state higher?
I think now we find out, because we're in the same range where we were when the year started, where the markets were essentially trying to figure out what all of this is going to mean. If you look at the bottom line, the situation does not look any better from a growth perspective, and you could argue that it looks worse, because you've now seen all kinds of hard evidence about the economic slowdown. You saw it in the GDP numbers for the first quarter, and no, not the crazy weirdness with imports and inventories. Even if you take that completely out of the equation, what matters is consumption, and consumption weakened significantly in the first quarter. The numbers we just saw last week, retail sales, PPI, they're suggesting a weak second quarter in the same direction. The consumer confidence numbers were awful. So April, May, you're already heading into a weaker sort of second quarter. The question is, does anybody care? And at these levels was the last time that markets cared. Right around here. So it'll be interesting to see now that sort of the hysterical part of the episode is over, and may be over, let's say, until July the 8th through August the 12th, when the new cliffhangers come. The growth story is something that hasn't improved. The tariff overlay has become worse, if only because the base tariff is now 10, whereas it was 2. All around, including China. So you're in a down growth environment, no matter how you slice this. If the markets have a week now where they don't get substantive sort of stuff to speculate on day in, day out, there's no like, oh my God, on Wednesday there's this number. If they just are left to their own devices and they're left to think, I can see both ways that this works out. There is an inherent upside kind of magnetism to stocks. They're biased that way. And so they just find their way to the top of the range. And we test the yearly highs before we really decide. Or the markets get left to their own devices and they remember what is going on in the bigger picture. On Friday, the PMIs should help to clarify that, but that's on Friday. There's a long time between then and now. We'll hear
lifetime.
from the RBA. That's a good barometer of what's going on with the impact of the U.S.-China thing. We'll hear from a bunch of different notables on the data front internationally. So inflation in Canada, inflation in the UK. That's interesting again in terms of where global growth dynamics are and what central banks are ready to do about it, which isn't much. But really, it's, do the markets use this lull to zoom out, or don't they? And this is where we find out.
Dylan, let's swing our attention away from broader stocks into some of the commodities here. Oil has been something that you've consistently said for weeks now is worth fading when it moves lower. It holds up here today. We get knocked lower initially, but we bounce back. Is this just another notch in the belt?
Do you think oil is ultimately still trying to sort of calibrate economic strength and global trade? Like last year, I feel like oil was very much a barometer of probability of global conflict-based supply disruption. And this year, I feel like oil is a discounting growth and number of widgets moving per gallon around or per barrel around the world. And I just think that oil got cheap on that. And so I think that how can I be bullish how can I be bullish on everything and not be bullish on oil? Which is kind of where I've been coming from. I mean, I was bullish on oil before I was bullish on everything. I was bullish on oil when I was bullish on nothing else, and I didn't even understand why the stock market was up so much. But at this point, growth, I think, is more good than bad, and global demand for energy to move objects around the world, I think, is unlikely to be meaningfully disrupted.
Dylan, so you're still leaning long deltas here. Ilya, you have the opposite point of view. You're kind of riding this out on the short side.
Mm-hmm.
How do we know that this is perhaps the issue that I'm trying to overcome? I acknowledge the macro issues more than I would have, say, 6 months ago.
Sure.
However, given the dynamics in play right now, in a typical 45 in, 21-day out cycle, it doesn't seem like this may be the window with which those fears are realized after having just come off of such an extreme sentiment event like we did in early April. And then, of course, the various incentives in this market to kind of chase higher for second quarter so people don't lose their jobs as professional money managers.
I mean, maybe not. Sure.
Why is the timing right now to be short oil as opposed to, say, later in the summer?
Let's talk about tactics and what you actually see on the screen, because I think that's how I'm in this position. I'm not looking for some sort of grand unraveling of growth as a catalyst for this, though, of course, it jives with my world view on the macro side. But here it's the price action. First of all, you're at resistance. You're at the range top where you've held before. So the risk reward to going long here is awful. There's not much room above you. There's all kinds of room below you. The risk reward is better on the short side. If you're wrong fast. If you're right, you have more space. You have on the daily chart signs of reversal. You're setting lower highs. You're starting to set lower lows. If you zoom in on, let's say, 4 hour, 8 hour, you start to see the bounds of the last upswing from the range bottom. Those have given way as a kind of sequence that's pointed higher, higher highs, higher lows. That's violated now. So, and we haven't undone that. We haven't set a new high. We haven't broken out, nothing. So for me, this is just opportunism. You've stuck in a spot where the risk reward makes sense better on the short side. You're stalling. You've put in some signs of topping. moderate, but some of them. Okay, if you can take a risk-defined shot, as I've done here with an MNQ put vertical, then okay. I'm not looking for some grand unraveling here. Revisiting the range bottom would do just fine.
Dylan, I'm still leaning net long, but not like long CL. I'm still short the put spreads myself, kind of in the sense that I think that it's stopped falling. And, you know, again, on the other side of OPEC's announcement that it's going to raise production by 411,000 barrels per month, it shrugs it off immediately. You get one down 4-hour candle coming out of the break that first week of May, and then since then, it's just been a slow and steady grind higher. It feels like we've neutralized a lot of the fear that's been in the market. It's still a 47.2 IVR. I think perhaps the most promising aspect of the chart is that for traders who are looking to engage us now for the first time this year or this month, or they're just looking for a new opportunity in oil, we're pretty darn close to the halfway mark of the high-low range that forms around all this tariff talk. The pre-Liberation Day high down to the post-Liberation Day swing low. The midpoint of that range comes in right around 62.60, 62.75 or so. And taking a directionally neutral position going out to 59 days, as it were, wrapped right around a dollar wide, the one standard deviation of the recent trading range, 71.72 on the upside, 52.53 on the downside. You'll see that that's basically the high-low range here. Even if you're bumped out to the next month contract CLQ5, you're looking at 65% probability of profit, risking 3.5 to make 1. It's not the sexiest trade. It's not a madman's delight where it's like 10 to 1 plus on the gain, but also it's kind of just steady work if you can get it, it feels like.
And it's more likely to pay.
Obviously.
Yeah, and going, $2 wide, right, you can make small adjustments here to perhaps change the risk to reward. It's, each their own. But there are ways to slice this apple right now where I don't think you need to be directionally, bold or beared up, even though the three of us happen to be directionally bold or beared up on the table right now in variety form and fashion. You're full bull. I'm like a cautious. It's my wedding crashers trade, right? Like you're going to stop falling. I don't know if you're going to rally. And Ilya's a little bit more bearish, so pick your poison. But I think that you have there's still something to work with here. This isn't like the end of last year when oil was chopping around and you were looking at like a 17.2 IVR. At least there's something to do here in the short term. Ilya, gold today is worth discussing as well. 1.46% to the upside. Unlike stocks, which fell at the open and rallied back, gold rallies at the open and more or less stays up there. It can't clear that 1 month moving average by the close, but it still gives you a near 1.5% gain, we'll call it. Do you have any more conviction today than you did during Futures Power Hour? Because this kind of feels like a no man's land. Yeah. In the short term, technically, given the broader implications of a decline at top that could be in play.
Yeah, I mean, it seems like what we said earlier today basically holds. So this thing had a really clean sort of range break that it ultimately couldn't make anything of. It tried to break lower, right where you have the 100% fib level there around 3,200. There was a clear kind of support there. It held. The market came into it, stopped at it as if to acknowledge it, then clearly cleared it on the downside, then recoiled back up, then back down, and now it's holding, and it isn't really recapturing any ground. So it's aborted a break lower, but it can't muster a bounce. This is kind of inconclusive here. So I'm biased long, sort of thematically, but I don't think there's anything to do here until this thing decides.
Dylan, gold seems like it should have had a good day today. I can't help but think of a 2011 move that gold has in August and early September that year. Then again, I don't think that gold did anything spectacular after the Fitch ratings downgrade because, again, I couldn't tell you what happened when Fitch downgraded the U.S. It's such a non-memory for me. Do you think that this is the deciding factor for gold, or like everything
Don't
else?
ask me about gold. You know I don't know a damn thing about gold. I'll talk about tech stocks, bank stocks, oil stocks, silver.
Well, surely
I
gold.
I will lose the last shred of my credibility if I start giving opinions on gold. Gold is nonsensical to me. It doesn't make it. I don't know why it even exists. I don't know why it goes up. I don't know why it goes down. Risk off, risk on. I don't know. But why is it going up in a risk on environment? I can't tell you. Then you talk about the Chinese. What can I do? I have no idea.
Okay, so give me something on Bitcoin, though. It feels like this is,
Bitcoin is, I think, all of this, the thing with Bitcoin is, as annoying as it is the longer it sticks around, the more likely it is to be valuable, right? Like now it's just in a game of like, the more sort of wacky things it can live through and perform through, the more it takes on the ambiance of a store of value, which is sort of, I think, the fundamental ambition for this idiotic digital con job. But I believe that it is, I actually think that the last year has been really good for Bitcoin. Not obviously it's been good from price point, but just in terms of longevity and presence as a store of value. I would rather own Bitcoin than gold. Let me put it that way.
Dylan, if you just called it a con job, I'm going to have to question your "I'm bullish on everything" credentials.
Just because it's a con job doesn't mean it's going up. Or not going up, sorry.
Look, 105.880.
My moral opinion is that's a different show. I mean, this racket is which way is she gonna go, Sam? I'm saying up. Whether it's really a value creating enterprise or a real store of value. I mean, look at come on. Bitcoin, come on.
Ilya, what's the price point by which you say something positive about Bitcoin?
If you want to look at Bitcoin here as just any tradable asset, I have no problem saying that it'll go up, it'll go down in a completely dispassionate kind of a way. Where I stop saying nice things about it is in the part of the story where people go, this is more than just another financial vehicle that can be increasingly in an increasingly liquid way punted back and forth depending on what you think your opinion is. All good. Where I get off the boat is where you start to tell me that this is the future of money. And that's where I go, right, okay. What I think is very, very interesting is actually the cover of this week's Economist was about how crypto has become the swampiest of financial assets in terms of its closeness to power and influence in the sort of political Tammany Hallness of the current moment, to invent a concept. But if you look at the price dynamics here, it's pretty clear. I mean, look at it on a continuous contract, or even here, but on a continuous contract, you see it a bit closer. You're basically at the range top. What business in the world do you have going long here? If you don't have exposure already, either it breaks or it doesn't. But the risk reward to buying until it does is terrible. Absolutely terrible.
Yeah, it has been a very good year for crypto in that regard. Yeah, I mean, I don't find it surprising. Not an original thought, but I don't find it surprising that crypto is swampy. There's a really good documentary. Vic and I have talked about it on Jones and Friends years ago. It's called Line Goes Up. I believe it was released in January 22 or December 21, right near before you go into that big crypto winter. But they talk about the genesis of the crypto industry and, the early days in the global financial crisis. And
well, remember, can I just interrupt you? Because also I have a reason that I'm a little bit irritated. Because remember, I was the host of all. I was very active as a very high profile financial journalist in that 2008, 9, 10, 11 zone, and had many individuals approach me and insist that I buy Bitcoin.
Buy Bitcoin because it was an alternative system.
Not the dollar. Money. The dollar's screwed. America's screwed. Blah blah blah. I was like, America may be screwed, but I sure as hell ain't buying your stupid funny money.
Well, I think
was not a good decision on my part, if you understand what I'm saying.
If you think it's a system that's set up to be an alternative to the U.S. dollar, to be a parallel to the fiat currency world,
or just to be a non-sovereign currency,
a non-sovereign currency, but with that comes power, right? And one thing that this documentary Line Goes Up pointed out is that a lot of the original people involved in crypto looked at the state of the world, and this is not to say that this is Satoshi, but the people who were early adopters, and said, the banks and government put their foot on our necks. It's time for us to design a system so we can put our foot on theirs.
For sure, they approached me with that very email.
Right. I'd encourage people. Yeah. I would encourage people to watch the documentary. It's interesting. This is during the peak NFT era, and it's really in a response to like how NFT is just all bullshit, which if you don't think it is, like go check what that Beeple NFT was auctioned for what was it, several tens of millions of dollars years ago. See what it's trading for 60. Right now. So it was 60 million. I think it was for under like around 100K was its most recent listed value. Like check the JPEGs of rocks. How much are those worth right now? Or the crypto dick butts? I can't believe that's a thing. That word just came out of my mouth.
I mean, don't you think those NFTs were just money laundering at the end of the day, or some sort of racket?
My most controversial opinion, Dylan, is that all high art is money laundering. All of it.
I think that's reasonable.
All of it. How can you assess a proper value to anything? Eye of the beholder.
And you're going to move $100 million in a painting? Come on.
So there was this really great piece. It's a wonderful documentary called Thief in Law about Russian organized crime. And they're talking to this guy living in France, and he's explaining that everything is relationships. Money means nothing. And he goes, look, give me a piece of paper out of the printer there. Scribble something on it. I'm going to call my guy at Sotheby's, and I'm going to tell him to hang it up there for $100 million. And because he knows me, he'll do that. And 100 people will walk past it and think it's nonsense, and the 101st will say, there's no way I'm giving you 100 million, 50 tops.
Yeah, that's my opinion.
That's why they call it a racket, my friends.
Mm-hmm.
Also, I'm not an artist, so I have not laundered any money through paintings or PPP loans or USAID.
But maybe you should get a PPP loan in order to finance some painting that you can sell to USAID.
Keep going. Keep going. You're cooking. Keep going.
Then call Hunter Biden and get him to buy it from the USAID.
And we'll get the Trump coin financing.
And then resell that for Trump coin to Don Jr.
Yeah, for warrants on.
Now we're talking.
For warrants on future. Okay, yeah, we got this. Yeah.
Well, but
okay, this is
all jokes. What do you guys need? What do you need to see Vecchio to get pulled up here? What's your problem?
On what? Equities?
Yeah.
Oh, you and I didn't have a chance to speak last Wednesday because I was nursing this neck thing, and then Thursday you were out. I purchased calls in the NASDAQ for new all-time highs last week. So I'm there. I think that the incentive structure of this market is totally warped right now in the short term, thanks to the fact that retail held its ground throughout early April, and institutional and professional money managers jettisoned the market over the course of March and early April and really never jumped back in. I know Tom will quip that if you look at overall account balances, it's not that people were necessarily buying the dip, it's just that they held their ground per se, and that's fine. That's good. You didn't lose the money then. But in the short term, Ilya and I were talking about the positioning update from the CFTC COT report that was released Friday, which covers the trading week through each Tuesday afternoon. So this does cover the market reaction last Monday and Tuesday on the heels of the China-U.S. trade detente. And professional money managers who speculate in the futures market got more short. So they were already short, and they got more short coming out
by a lot, actually.
But yeah, so Dylan, people right now are saying that this thing is going to go down when it's going up. There's room for short covering to fuel a move to the upside still. There's also the fact that now you have a lot of people who are staring down the final 6 weeks of the quarter who abandoned long equity positions are now looking at a market that's 17, 20% higher in the rearview mirror. And they have to paint the tape to justify people keeping funds through them through the middle of the year. Because if they were saying, don't panic, don't panic, don't panic, Trump's just another president, don't worry, okay, he's not going to do anything, he's all talk, and then the market melted down, and then you capitulate here in April, and then the thing just ripped higher. Sure, you were right that he was eventually not going to do anything destructive, he's all talk, but you still lost money along the way, so tough shit.
Mm-hmm. Are they getting more short because they're hedging more, because their core position is long outside of futures?
There is okay, so this is the thing that I keep, Tom and Tony bring this up with me too. Mm-hmm. Within the COT report, we know if people are using the contracts for bona fide reasons, like hedging off existing risk. The speculative position that I'm talking about is explicitly for people who are just playing CeeLo on the sidewalk to try to make an extra buck, right? Like, we are not talking about people who are using S&P 500 contracts for hedging reasons. We're talking about people who are purely using them. We know this. We can disaggregate the data
with confidence.
We can disaggregate the data. It's in the CFTC COT series. We can look at bona fide hedgers, commercial hedgers. Who's a commercial hedger in equity futures? No one's out there growing equity indexes on the stock, right?
Right.
Right. So the only reason why you would be a bona fide hedger by definition for equity futures is because you have the underlying. You own the underlying, and you are hedging the underlying stock that you own. So that's how they disaggregate it. People who are rolling the dice in the equity market still are trying to fade this thing, and that is not typical action. So I think the incentives, Dylan, are for this market to squeeze to the upside. Ilya, I think the PMIs this Friday are going to be absolute garbage. It's funny that it's happening 3 months later on the dot, because it was the February batch that gave us this spillover here. So maybe that's the move this week. We rally up a little bit more, and then Friday checks us back down. We close the week unched. And then we go into Memorial Day week, where next week it is a shortened week. But you know what? With that, overtime is now out of time for this Monday, May 19th. We'll be back tomorrow on Tuesday, May 20th. Until then, for Ilya Spivak, Dylan Radigan, I've been Chris Vecchio. Ilya's coming back, though. He's here with Macro Money up next on Tasty Live. See you there.
See you there, everybody.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Your crypto needs a wallet. And crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
Having trouble understanding what your trader buddies are saying? Here's what it means when they say catch a bid. The term catch a bid is in reference to the stock's price action. The bid price is the price at which you can sell a stock at. When a stock continues to go down, so do bids, meaning the price at which you'd be selling the stock is continuing to go much lower. If you miss it, you can't catch a bid. It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide.
I tend to call myself a lonely options trader because I really don't have a lot of people that I can share stories of wins and losses with. Like Tasty Live plays the whole day at my house. I love that they've made everything really easy to digest and take in. I love that you can easily send an email if you have any questions and Tom will be quick to respond to you, or if somebody else, Nick, Tony. I really enjoy that it's a customer focused and it's a customer centric system that you guys have here. And Tasty Live has definitely changed my life financially because I'm able to determine how and where I can make my gains and not be a passive investor where you're just relying on the markets to do something for you. You could actually go out there and do it yourself.
Calling all traders. Are you using Tasty Live mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, Tasty Live has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
All right, Julia. All right, Nick. All right, Mike. All right, Jamal. All right, Glenn. What was the last trade that you made?
Oh, it was bad.
Oh, man.
I bought SQQQ. It's like a 3x inverse ETF. I feel like I get shit on for the inverse ETF trades. They're not, I wouldn't say they're always good trades, but I'm like, I kind of don't want to get in the options right now, but I want some leverage.
I got long some Apple, and it just happened to work out in the last about 5 minutes here. So I sold a wide put spread out in May, and it basically lost half of its value in the last 5 minutes.
My last trade was closing out a meta calendar spread that was worthless prior to the 500-point rip in the E-minis.
Last trade I placed was I closed out a put spread in SPY. It went well. I regretted to say it was a long put spread that I put on yesterday into the big move, and I closed it out since we retreated in price today, and it's worked out well.
Short gold options.
How'd it pan out for you?
We're still alive, but we're not looking good.
Tasty Live's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging, and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Oh, yeah. Tasty Nation, good morning.
U.S. credit downgrade? What U.S. credit downgrade? That's the question the markets are asking themselves after Moody's decides to lower the U.S. sovereign credit rating, and no one seems to care. We'll take a look at what all is going on here momentarily. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And we won't dwell too much on what happened here over the weekend because, frankly, its impact on the markets was minimal. It is interesting, of course, what that leaves on the table. So we'll look at what the week is likely to bring in terms of macro event risk and put that in context with what else is going on for the economy itself, because it does look like a picture is starting to crystallize here. And of course, as ever, the question first and foremost is, when do the markets start to care about it? So as we kick off here, let's first consider where we were at the end of last week. We can see equities had a nice run. S&P 500 up 5.2%, NASDAQ up 6.8%. Interest rates nudged up a little bit more as the risk-on move basically extrapolated across markets. It looks like, generally speaking, the overall sort of growth disposition was broadly well supported, and maybe not necessarily because of the economic data, because it didn't give anything particularly growthy. As a matter of fact, it looked more in the opposite direction, but it did look like there was a kind of further unfurling of the concerns that struck markets in April and a further recovery in sentiment, because the entire setup seemed to look like a little bit more favorable from bonds. Crude oil edged up a little bit. Gold fell. The U.S. dollar strengthened a touch against the euro and the yen. And so the overall landscape seemed to be one of relief and normalization across the whole range of assets. And then, of course, we opened this week having heard on Friday after the close that Moody's lowered the U.S. sovereign credit rating down from AAA. This, of course, follows the 2011 move from Standard & Poor's when they did that. In 2023, Fitch did as well. Moody's was the last holdout, so this makes all three of the big rating agencies that have done this now. And needless to say, the markets don't really care because, of course, not. It's silly to say that the world's most eligible borrower is not AAA, because that, of course, means the rating is some sort of academic barometer rather than a practical reflection of actual credit worthiness and risk. And that, of course, means that it doesn't make much good use to anyone in practical terms. So the markets duly shrugged this off after an initial wake-up call at the open of trade. You can see here the S&P 500, very little changed on the day. Ultimately, we gap down, we try to extend lower, and we ultimately close essentially on Friday's highs and ultimately don't go very far at all. Very tellingly, on the bonds side of things, we spike lower into these lows here on the 30-year note and very pointedly hold them and actually erase the entire decline following the initial gap. So again, bonds here telling us there is no sovereign credit risk that has been marked up significantly as a consequence of this downgrade. The market is very straightforward looking at this and saying, we don't care, this doesn't matter. The US dollar, a touch lower. This is the DXY dollar index, so an average of its value, of the dollar's value against the major currencies, albeit one that's tilted to the euro in the basket, because this basket was created before there was a euro, and so there's a bunch of legacy currencies that were there, like the Deutschmark, like the French franc, the Italian lira. And so the basket now, since all of those are now the euro, is very sort of lopsided, but nevertheless, it is looked at as a barometer of overall U.S. dollar performance, and you can sort of see here that you get a little bit lower on the dollar today, but ultimately you're within familiar ranges here, and a breakout is averted. And so the markets basically shrug this news off, which then fasts forward to what comes this week. And unlike last week, we don't have an obvious U.S. cliffhanger on the data front. We don't have an obvious standout like a Fed rate decision or an NFP report or some such thing. It is a more nuanced week, and it begins in Australia with a monetary policy announcement. And before we launch into it, it's important to consider that we are now in an environment where, without that kind of cliffhanger risk, the markets have perhaps a bit of room to ponder where they're at, especially since the reintroduction of tariff risk is probably off the menu somewhat until these 90-day cliffhangers for overall reciprocal tariffs above 10% in early July, and then those having to do with China in early to mid-August. Until then, this story is perhaps on the back burner, unless something comes out of left field. And so the markets have a bit of room here to ponder just what exactly is the broader picture, having looked at, in a very focused way, headline by headline, how this trade war scare is going to evolve. This is maybe a moment where the dust can settle. And so the lens for the markets may well be evolving as well, and broadening to the overall picture, as the sort of initial shock of Liberation Day and everything that followed really seems to, at this point, fade into market memory. So with that, we have a fully priced in rate cut from the RBA that's on the menu. We can see here it's not quite fully expressed in May because, of course, the meeting is relatively late in the month. It's coming Australia time on Tuesday. And what you have here is the spillover essentially into July's contract to really see it, but the expectation is that we're going to go from 410 to 3.85 at this meeting, and we can see it's fully baked in at this point. We see further rate cuts over here, at least one more cut on the menu before year end. Moreover, we can see that between the February and the April policy announcements, there's been a meaningful dovish shift in the pathway for rates that is expected. And since that early April meeting, now going into the May one, the calculus hasn't really shifted. So this has been relatively stable. If we look at the way that it's evolved in overall policy expectations, we can see, again, the markets expect just about 2 cuts for this year, and then stasis next year. There's a bit of optionality on a third cut this year, about 50-50 chance, but the market isn't leaning that way yet. And in any case, we've seen that since the beginning of May, policy expectations have unclenched somewhat and have become less dovish. Growth in Australia has held up reasonably well. This is the composite PMI, and although it ticked a little bit lower in April, we can see that the trend in growth since basically the fourth quarter of last year has been generally pretty positive. At least the incline is going in the right direction here. And the upshot seems to have been domestic demand, which in Australia has held up a little bit better despite stress externally. Moreover, we can see inflation has started to kind of anchor around the central bank's target. So here's 2%. Australia allows for a range. And so we're kind of anchored right where we need to be, give or take, relative to history. And so the RBA perhaps finds itself in an interesting position here, where they're expected to cut. They will almost certainly deliver on that cut, looking at what the markets have priced in. But the question then becomes, well, that much is expected. What's going to be the market moving bid? Australia looks to China as its largest trading partner. And the export mix, the goods trade between them, is very sort of industrial input growth type of a mix. It's mainly coal, iron ore, and the like. And so there's a lot of sensitivity here for the kind of knockback to Chinese growth that a trade war with the U.S. would ostensibly bring. And so the really interesting thing here might be not so much the decision, which is well expected, but the RBA's vantage point on the economy and how it is likely to evolve in this environment. Because what that essentially gives you is a view of how this trade spat is spilling out and where its impact might be appearing relatively early at the start of the global supply chain, at the commodity inputs part of it. And so, in this sense, what the RBA says about what is coming next might be more interesting than what they ultimately do. And with inflation anchoring near target, with growth generally well supported, or so it would seem over recent months and quarters, the upshot may well be that there isn't really a reason to do much of anything, but to back away and let the dust settle. Seems to be a popular perspective on the fate of the trade war at this point. And what that would suggest is that this is a central bank that isn't in a hurry to react and is waiting to see, and is generally taking a relatively hands-off approach. It is a similar upshot when we get to the UK, which is the next place where we look to event risk. The CPI numbers here due for April, and they're expected to show us that inflation picked up considerably, 3.7% expected at the core, 3.3% at the headline. These are significant historical reference points when we consider where this has been before. This is quite the increase, actually. For the headline, this would be the fastest since February 2024. For the core, the fastest in 3 months. We see here that the Bank of England has seen its rate cut expectations moderate somewhat. We're looking for 59 basis points in cumulative easing now through the end of next year. We can see next year is about a coin toss as to whether we'll get another cut. But this year seems to be tilted in the direction of 2 more moves. What's really interesting here is that since March, so over the past 2 months, we can see that the range of speculative amplitude, so how much the markets are prepared to swing to dovish or hawkish, it's significantly narrowed. So policy expectations seem to have really anchored around a sort of mean here. And March was a little bit less dovish. We can see here earlier this month, that policy announcement gave us something that was a little bit more dovish relative to where we are currently. And so the markets ostensibly read that announcement as having a little bit more sort of defensive of a tone in terms of the current posture, a tone that wasn't ready to really get behind a lot more easing. And so we've backed away here. And so we can see that the markets don't really expect any fast changes from the Bank of England. And if we were to see inflation pop higher, that would at best reinforce that view. So once again, we have a central bank here that is unlikely to get pulled into action quickly. Now, this is not unlike the Fed, which also has been resisting calls to act even as growth indications have started to point lower. And this is really where both the UK CPI and the RBA policy announcement make for welcome stage setting, because they tell us that global central banks are not in a mood to react powerfully to growth risks. They are at this point sitting back, and they are inclined to be reactive more so than proactive. Now, this all gets very interesting on Friday when you get an update on global growth dynamics via the S&P Global PMI roundup for May. And we can see really the main story here is the composite for the Eurozone expected to remain near standstill. Of course, these are as ever in a range where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so at 50.7, after a reading of 50.4, you're essentially hugging standstill. And looking at the US side of it, similar story, 50.6 to 50.4, again, hugging standstill. That's not especially encouraging when the last time we looked at these numbers, this is April's bottom line, the global PMI numbers. These gave us the weakest performance in 17 months. And that's largely as the service sector unraveled globally, which pulled the overall composite closer to this 50 neutral level. And that's despite the fact that on the manufacturing side, there's actually been a little bit of a bounce, ostensibly amid front running of the trade war, trying to stock up inventories, which is, of course, exactly what we saw in U.S. GDP data. More on that in a second. But we know from having beaten it extensively on this show, 58% of global growth is just three economies: China, the Eurozone, and the U.S. These PMI numbers due Friday are going to tell us, or at least the expectations are, that this part of the pie is at standstill. Now, that's not news for the Eurozone or, for that matter, China. In fact, if we look at how these composite PMIs have evolved, the Eurozone and China have drifted into essentially standstill over the course of the second half of last year, and there they remain. The difference maker last year was the U.S., which was growing very strongly, and at one point at the strongest level since back here in 2022. But that has since given way to standstill, and these numbers are likely to tell us that that remained the case from April into May. Which, of course, raises the question, if all three of the world's top growth engines are out of commission, and the other 42% are mainly vendors servicing demand from these three, well, then where is global growth supposed to come from? And if it's already at a 17-month low in April, where is it going in May? Now, the indications that we've seen about where the U.S. is heading in this framework, since it is the U.S. making the adjustment, the other two are already at essentially anemic growth, then it behooves us to remember that in the first quarter, we just saw these GDP numbers. The bit that was consumption was already the lowest in almost 2 years, going back to the second quarter of 2023. Obviously, there was these massive distortions to imports and inventories, a part of investment here, as a response to front-running the tariffs. But if we take a look at what GDP is actually made up of, it is 68.5% household consumption. Once we net out exports and imports for their contribution to GDP, we're talking about less than 5% of the total. Now, last week, from retail sales to PPI, the story seemed to be that this weakness in consumption is liable to get worse in the second quarter. The retail sales number was soggy despite goading from the administration to front run still more tariffs with Liberation Day and then its pullback just days later, at least partially. The PPI numbers showing businesses are eating the increase in the cost of imports for now and insulating consumers. So they had every reason to try to front run these tariffs, and yet they didn't. And then, of course, there is what the landscape looks like going into May, which saw the worst consumer confidence readings since the lows following the opening from COVID. Moreover, a surge in inflation expectations that exceeds those COVID highs by almost 2%. On your inflation expectations now at an astronomical 7.3%. Now, that doesn't seem likely, but it tells you where consumers are. And of course, again, if consumers are what matter, and they are not going to stop being defensive, if that's the case, well then this is likely to continue. And this is likely to get weaker. And global recession is likelier on the horizon, with central banks, perhaps Exhibit A from the RBA and an implied Exhibit B from the Bank of England this week. They're likely to follow the Fed's lead and do relatively little until it is painfully obvious that action is required. Now, will the S&P begin to care about this part of the story? Will that start to register in sentiment? Well, the last time it cared was right around here. This downturn starts with a bad set of PMI numbers. That triggers the beginning of the growth scare that then becomes the hysterics of Liberation Day and maybe a sovereign spook in the U.S. and maybe a currency crisis until cooler heads prevail. And so the question for this week will be, with the benefit of a lull in U.S. headline-grabbing data, at least until the PMIs, will this be the point where the markets reevaluate and come back to the idea that after all the fire and fury, what they're left with is more global recession risk, not less? Or will we continue to ride the sentiment improvement as relative to the beginning of April to still higher highs? And this is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be on with Chris for Monday and Friday editions of Futures Power Hour, as usual, this week. On with Victor Jones for the Price of Truth on Tuesday. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Thanks very much for joining. Macro Money's back tomorrow.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, two female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Your crypto needs a wallet. And crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today. All right, we're back. Tasty Crypto Show. I'm Ryan Grace, and with me today, of course, fan favorite Greg Magadini, co-founder of Genesis Volatility and now director of derivatives at Amber Data. Greg, thanks for coming back on the show. How you doing?
Doing great. Thanks for having me on, Ryan. It's always a pleasure to be on.
Absolutely. It's good to see you, and we have a lot to talk about. I think when we last caught up, that was about a month ago, I think April 23rd to be exact. There was a bit more positive sentiment in the market, if I recall. Bitcoin trading back above 90 or so. A lot's changed since then. What do you make of the price action? What are you seeing out there?
Yeah, I mean, we're getting kind of just a nice climb higher in sort of the spot prices for Bitcoin. So to me, this is doing what it's supposed to do type of deal. So I like that. And in terms of the vol markets, there's still interesting opportunity there. We have a very steep contango term structure. We're kind of hanging out right below all-time highs. Implied vol and realized vol are kind of at lows year to date. And I have a hard time not seeing, if we get that breakthrough to new all-time highs to be kind of a mover and shaker type of event. So there's, things might be lining up, like it might be a vol trap too. So keep that in mind. But I think we're getting towards that inflection point where things are getting really interesting again.
What do you make of the low volatility here? When I look at Bitcoin, I've got an implied vol, let's say, closer to 40%, 50% or so. A little bit different when I look at ETH. And then we often like to just kind of measure where that is on, let's say, a 1 year basis, a 6 month basis, what have you, but just kind of get a sense of, where is that within the range? And you look at Bitcoin implied volatility, and as you alluded to, or as you mentioned, it's right there near the low end of the range. At the same time, you've got Bitcoin prices that are pushing towards almost new all-time highs. We've got a range of about 75 to 110 or so here on the screen. But what do you make of the low volatility is it here to stay? Is this a reflection of institutional participation and kind of the maturation of the space, or is it only a matter of time until we're back at 100% implied vol for Bitcoin?
Yeah, that's a great question. I would say your point about the institutional activity, those are kind of the structural flows. I do think the structural flows are a downward pressure on volatility as the asset class matures. But I wouldn't discount sort of the cyclical moments that we can get. Maybe I could just share one of my charts here. I have a chart showing the implied versus realized volatility. So this is the 7-day implied versus the 7-day realized year to date. So just as we talked about, we're really at these year-to-date lows, realized and call it the 35 handle. They're very short-dated, implied around 35. As you mentioned, sort of the 30 days, more around the 40 range. So this is kind of interesting for a couple of reasons. One is there's the absolute level of vol, but then there's the variance risk premium, which is actually pretty narrow here. There's not a lot of implied premium to the realized, which is usually what you're selling implied for, to capture that. And then something else that's really interesting is if you look at the term structure, the front end here is very cheap, or is the lowest part of the curve. And if I go ahead and contextualize that historically speaking, you can see this chart here. It's looking at the backwardation / contango extent through all the relative markets. 1.0 is a perfectly flat term structure. When we have these vol events, call it COVID or FTX bankruptcy, we get about a 1.32 sort of top formation, which means the front end is 30% more expensive than the mid, which is 30% more expensive than the back, so on and so forth. But today we're kind of at, near that lower end of steep contango. So I do think this is something to keep in mind in terms of opportunities. And if I look at this nice little chart we have here, that's showing us past implied versus current realized, which is giving us the realized variance risk premium. We can see that that vol buyers are starting to get paid here on the front end. Back end stuff, 60 days out, 30 days out, vol buyers definitely overpaid for realized, but we're kind of getting a little bit of that turning point in the front end. And I do think if we're making new all-time highs, and we're not there yet, but if we are going to make new all-time highs, once we're in that territory, it's hard to call tops. And I think there's a lot of momentum behind it.
You mentioned a volatility trap earlier. Is that a scenario where, sure, at this point, it looks like we, certainly have lower implied volatility levels. It could be cheap. Is that volatility trap a scenario in which it actually doesn't get more expensive from here, and it could get possibly cheaper on those longer dated options? So even though you're going out, you're buying a leap, you're buying something with a little bit more time, it actually gets a bit cheaper.
Yep. So that's kind of the thinking that I have in mind. I'm more thinking of the medium term to short term. So with that steep contango, you might be tempted to buy 30 days out, 60 days out, but don't forget, you're not only paying theta, you're paying roll down vega on that contango. So as we approach maturities, you kind of have that exponentially decaying theta, but you also have vega points leaking out of the market. So there's a lot of cost to being long vol in that scenario. And then something else to keep in mind is, we've seen these patterns before where assets make new all-time highs. Sometimes they consolidate right below that all-time high for longer than expected, which is very much a vol contraction type of move. So I would keep those things in mind. I'm very interested in sort of the upside, delta, upside, vega, as we're making new all-time highs, as opposed to anticipating a break of the all-time highs.
Okay, so you're kind of waiting then for, let's say we get the break of 110, and then you'd be a little bit more active in terms of going out and buying some of those options if that's your strategy?
Yep, I think that's a better way to play that.
What other strategies would you look at using here, to maybe offset some of that theta decay, or is there anything else that you'd look to do kind of with the current setup?
Yeah, so I mean that's a really good question, Ryan, because you wouldn't know it from my 2 appearances here on the show so far, but I typically like to trade short vol structures a lot better than I like to trade long vol structures.
Okay.
There's just something about, the long vol profitable profile is you buy something and you got to make the 10x because the other 9x it loses. The other 9 times it loses, 100%. So you got to be able to hold winners for a while for the long ball to pay off in the long run. And so typically that's not my favorite type of structure. But as of right now, those are the 2 opportunities that I see. We talked about the long dated IBIT leaps. Last time I was on the show, that's still a position that I think is really good. And then here kind of breaking these all-time highs. I like to play the options market a little bit better as opposed to the futures market or the spot market, just because there's just a little bit less spike down risk, shakeout risk from a levered long futures position than there is with just a long options position. But in terms of offsetting that, I would still probably keep it simple on my side here with this type of trade.
Awesome. Yeah, since the last time you were on the show, Greg, I actually went out and bought some longer dated IBIT calls myself, and they're working out. I've tried to kind of bounce around in some shorter term stuff, and what's nice about those options, obviously, you've got weekly expiries, but I've tried to, offset a little bit of the theta decay. Fortunately, there's not too much in there at the moment, but kind of followed you into that, and appreciate the trade idea. Yeah, forgive me as I bounce all over here, too. I've got a lot of questions for you.
Fantastic.
So when we go back to, I guess just looking at what's on the screen here, we've got, I believe this is looking at data that's coming from Deribit. Is that right?
Yes, Deribit data, yeah.
Is it fair to say that you would see or you're seeing the same thing in IBIT options? So a lot of what we're talking about, term structure and contango, some of the strategies that you could use in these environments, would that be applicable to IBIT as well?
Yep, absolutely.
Awesome. I think we got it loading on the screen here.
Yep. Bring this up here. So we can see that kind of term structure here right now in IBIT. And the vol is very similarly priced.
So when you go back to your personal portfolio construction, I know you've mentioned that you typically trade shorter dated stuff, and mostly you're in the options market. Do you carry spot positions? Do you ever trade other derivatives such as futures? Like, how else do you approach the market? Or are you primarily just trading options?
There's a few markets that I trade. So I'll trade some equity options here and there once in a while, but I usually trade S&P 500 future options, gold future options, CME yen future options, and then IBIT equity options. Those are kind of the main instruments that I trade. I'll trade some NVIDIA here and there once in a while, but that's basically a SPY option in a lot of senses. And then once in a while, I'll have like an equity bias. But I usually stick to the option market for the exception of very wide markets. If I really want to trade something that's kind of a off the beaten path idea and the equity is just much more liquid, I'll trade the equity in that case. But the reason why I trade options, even for delta plays, is because there's just always a shakeout risk in any type of asset. And I've seen it so many times where you get like this wick that kind of, any prudent risk management strategy would cause you to essentially cover your position. And it's always just hard to get back in after you just got wicked out like that. And that's what I like about options. Just that risk is not necessarily the same.
What about kind of longer term, I guess, investments in crypto specifically? Do you hold positions in anything outside of Bitcoin? Do you have any spot positions where you're looking at this as a longer term trade, whether it's 1 year, 5 years, et cetera? Like, how do you think about that if you trade those positions?
So when I was a younger man, yes, I did, and I had longer term positions. Today, no, I don't. All the money I made in crypto, I put it in real estate and put it in bonds and just use that as income. And the way that I trade my portfolio, I trade pretty aggressively, and I take the profits out every year and I put it in safe assets.
Awesome. Makes sense. I'm sure, though, you still have a Bitcoin price target or maybe other price targets in your mind. When you look out, let's say over the next 6 months or so, right? We've had a ton of noise over the last month. Tariffs, recession fears, the kind of ongoing trade war as well related to the tariffs. We just recently got the U.S. debt downgrade from Moodys, following Fitch and the S&P over the last couple of years, though arguably, given price action today, it's hard to say that matters much. But when you look at everything going on and you look at kind of the resilience of the Bitcoin price, do you have a sense of, or kind of a view as to maybe how high we go if we do break out? Are there levels where you think maybe now it might be time to buy put options and we're looking to play a reversal? Like, how do you think about the market over the next 6 months?
So I would break that question into two parts. There's always short-term trades that I think are interesting, and those are kind of like independent of my long-term bias or thesis. I think the longer-term thesis that I find interesting today, the gold market is at, I think it's around 24 trillion market cap. It's pretty high up there, and gold doesn't seem done to me. And again, I still think Bitcoin trades like digital gold. I think there's a few scenarios where the scariest possible thing would be trying to short Bitcoin. And one of those is, do people start buying Bitcoin as digital gold? And I'm talking about central banks, governments. Do we get that there is no offers on the books type of scenario where we get that squeeze higher in Bitcoin? That's where I think, my long-term investment is those, IBIT leaps, at least as of right now, that's what it is. And in that case, I want all that upside. That is one of those, the sky's the limit. That's one of those charts where you look at like railroad stocks in the 1930s and they just did crazy things. That's that scenario in the modern era. Sky's the limit, no price target, just don't get squeezed on the wrong side of it is the thought. In terms of kind of more realistic targets where, does Bitcoin go to 200K, something like that? Yeah, that's we could grind higher till those kinds of levels. But that's not really the scenario that I think people are kind of seeing could happen. We have like this fundamental shift in the world where maybe the US dollar reserve becomes a different type of world reserve currency. I want to see that play. That's not for the country, but for the fundamental value of Bitcoin. I think that's what happens in terms of making the asset worth a lot more.
Yeah, I completely agree. I mean, I think you're starting to see maybe the early signs of a shift away from, not so much the dollar, obviously as a reserve, but just the idea that the only pristine collateral or within the broader financial system, the collateral that you constantly want to hold is dollars. Not that you won't have dollars, or dollar-based collateral, but you're seeing some diversification away from it. I think to an extent, it kind of explains the price of gold here today and some of the flows that we're obviously seeing into these Bitcoin ETFs. I just came back from Toronto at the Consensus Conference, and as you can imagine, everyone there is super, super bullish, throwing out price targets of 150,000, 200,000. So you almost think that it's maybe self-fulfilling in many ways. But it also kind of concerns me, as a contrarian, when everybody's on one side of the trade or one side of the boat, you kind of look for opportunities elsewhere. Do you see a trade in the short term to the downside? Do you see any room for a correction? And if so, where would you look at kind of in terms of price levels that this might be going to?
I don't. I think right now there's a lot of upside momentum, and I'm not interested in downside trades, and I don't really see them right now. Especially with equity assets, risk assets, risk on assets having this nice recovery. There's nothing that I find interesting. There's always you could be in cash trade. That's totally fine. But playing the short side here in this momentum, there's just better opportunities in my mind right now.
Yeah, and I think we kind of already saw it, right? I mean, throughout a lot of these bull markets historically, not that this has been around that long, but previously you do often get these corrections of 20 to 30%. We just had the 30% correction, local low of 75, and the buyers stepped in. So it would be odd to me that you would get an immediate correction. But at times too, I wonder, does this with a very low volatility, does this present an opportunity to maybe buy puts as a potential kind of lotto ticket? But I tend to be with you that, you want to stick with the trend here.
Yeah, that's a great point, Ryan. Like, I definitely think still stick with the trend. But if you want to do a lotto ticket trade, like the risk reversal trade is always interesting. You could buy the put, sell the call, delta hedge with the asset, that's kind of a delta neutral position. Nothing happens, no harm, no foul. If you get sort of that crash lower, put vol's going to come in. You'll pick up negative deltas on the way down. That's kind of a nice way to play that. And if we break all-time highs, take that position off.
Well, I hope that we do. Are you active in anything else outside of Bitcoin options? You trade ETH options, or I think there's Solana options and probably many others on Deribit. Is that right?
There is, yep. There's some interesting trades on Solana right now that I've been kind of pointing out. We've had a big seller of May 31st expiration $200 calls. It looks to me like an overwriter, someone who owns the asset is selling covered calls against it, but they're selling in size. So they sold, I think, last time I checked, was a block trade of 100,000 calls, something like that. That to me seems like one of those times where you're an investor who sells a covered call, and then like a couple weeks later, you regret selling that covered call. I think there's one of those opportunities where taking the other side of that flow could be very interesting. So to me, Solana still has wild card upside in it, and I would not be a seller of 200 calls, even if it's just 2 weeks out. There's just too much risk there. And I think this could actually be an entry on the buy side.
What about ETH? Are you seeing anything there in those markets?
So ETH is very interesting. I like that ETH has been a beat up asset. And if you look at the Bitcoin ETH or the ETH Bitcoin ratio on a weekly chart, for example, the past 5 years, weekly candles, there's a lot of upside for this ratio to keep going higher in ETH's favor. So to me, it might be one of those assets that's very under-owned and we get above 3,000 pretty quick. So I wouldn't discount that scenario. And if we look at the Bitcoin dominance ratio, let's remember, Bitcoin is trading as a risk asset and a digital gold asset, whereas all the altcoins are trading more as risk assets. So if we're looking at outperformance in the crypto space in this sort of equity recovery or risk on recovery, I expect altcoins to finally start making up some ground. ETH would be one of those.
Do you think we have to see Bitcoin hit a new all-time high? Let's just throw out an arbitrary level. Let's say it 150. Does it have to go there first to then ignite that FOMO and maybe some of the rotation into relative underperformers like ETH? Or could you see, just simply given that ETH BTC ratio is relatively cheap, you could see traders step in there and bid that up to, let's say, 500ths of a Bitcoin? Man, if it got to a tenth of a Bitcoin at this price, you'd certainly want to be long some ETH. But what do you think kind of happens first? I mean, ETH has been, as you mentioned, so beaten up. It's been left for dead. No one's really paying attention. But that said, I mean, Bitcoin dominance is what it is at almost, at 3-year highs here.
Yep, that's a great question. That is, does crypto trade like 2021 or does it trade like 2023? 2021 was really like risk on, rah, let's go crypto. Altcoins did very well. 2023 was more a SVB banking crisis, geopolitical wars, monetary policy hedge, digital gold. That's what's driving crypto higher, therefore Bitcoin leads. I think we're still in the Bitcoin is digital gold, Bitcoin leads higher world. I think those are really the big questions that the world is asking itself in terms of trade wars, global supply chain disruptions, global monetary policy. When does the Fed finally cut rates? Blah, 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 blah. To me, those are Bitcoin narratives. Now, risk assets recovering over the past 4 weeks since the trade war sort of initial spike down. That's been good for altcoins. But I think that's a nice short-term trade. But I think that the narrative in the medium to long-term continues to be Bitcoin-led.
Okay. Bitcoin over everything for now.
Mm-hmm.
Outside of options, I mean, what else do you have your eye on? Sticking with crypto, are there any other themes that you think could emerge, will emerge this cycle? Is there anything else that people are kind of sleeping on? We had the AI narrative for a moment. I don't think that's dead, but clearly it's again been Bitcoin over everything. We've had real world assets, layer 2s. What are you focused on, if anything, outside of kind of short-term options and what we've talked about already.
Yep. I think one of the things and one of the themes that we're going to start seeing, so we're going to see consolidation in the space. We had, this Coinbase acquiring Deribit announcement hit the wires. That's very interesting. But some of the other unknown things or lesser known headlines, for example, Derive, formerly Lyra, just got an offer for acquisition by SNX or Synthetics. And so obviously there's a lot of altcoins that are governance tokens floating around in the ether. There's an incentive for someone to buy up the tokens and essentially do sort of a acquisition, whether it's hostile or not hostile, but to essentially buy that tech. And when we're in this kind of people are not thinking about that environment, I think we could see some more of these types of acquisitions. That's very, very interesting to me. So we'll see what's going on there.
Yeah, that is interesting. I didn't see that at all, the Synthetics Derived news. So that's pretty cool. What do you make about the Coinbase Deribit acquisition? I mean, clearly it's positive for Coinbase.
Yeah, I mean, I am very excited. I think this is really good for the space. Obviously, Coinbase has Coinbase International. I think for the most part, business as usual, international only, U.S. investors still kind of closed out. But I think kind of thinking down the road, Coinbase is telling itself, hey, we're going to fight that regulatory battle a little bit more for the derivative side. And I think that'll be great for the crypto vol space.
You think we'll be able to trade crypto options via Coinbase, via Deribit in the U.S. soon?
Soon? I'm not sure. But eventually, yes, I do think so.
Fingers crossed. I guess we have IBIT options for now.
Mm-hmm.
Yeah. Anything else, Greg, before we wrap things up that you've got your eyes on? I appreciate you coming on the show as always.
Yeah, thank you so much, Ryan. The only other thing that I have my eyes on are, ETH ETFs that are returning staking rewards. It's going to be kind of interesting, especially if you look at the futures market and the futures term structure of ETH versus those ETFs, those hedgeable ETFs. I also think the Solana futures market is very interesting. That's trades at different valuation than the Bitcoin futures market in terms of futures basis. So I think those are interesting opportunities out there as well. So let's not discount basis trades. There's some good stuff out there.
So is there, I guess really quickly, is there a decently wide spread when you look at the basis trade for Solana futures?
Yeah, so there's a negative basis in Solana futures and or call it a backwardated basis in Solana futures and a contango basis in both ETH and Bitcoin. Now, let's remember that a basis trade is delta neutral, and so you can essentially do some very interesting stuff against those and bet on some sort of convergence, or just wait it out and get paid. Or you could do some sort of relative pairs trade and capture the basis along the way through both of them. So, short the ETH future, buy the Solana future type of thing, get a built-in, call it 7% spread to own that, and so on and so forth.
I love it. Greg, thank you, as always, for coming on, delivering the alpha per usual. Always love to hear your unique insights and take on the market. So thanks again, my friend. Before we let you go, where can everybody find you or learn more about what you guys are doing? And you're doing some great things over at Amber Data.
Yeah, absolutely. So anyone who's interested in looking at some of the volatility surfaces or futures basis or anything like that, you can go to pro.amberdata.io. And if you want some weekly recaps, you can go to amberdataderivative.substack.com.
Awesome. I'm already a subscriber, so we'll leave it at that. That's going to do it for our show. Greg, thanks again for coming on. I will be back on Wednesday. Until then, I'm Ryan. Peace.
At Tasty Live, we live and breathe the markets. But when the live show's over, are we out of breath? If you want to inhale the latest breaking market news, we've got you covered. The Tasty Live research team and on-air personalities post refreshing content updated daily covering earnings, economic reports, trade ideas, and much more. If you want a breath of fresh air and not stale takes, visit the News and Insights tab at tastylive.com.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
All right, Mike, we have earnings coming up next week in a time of high volatility and a lot of uncertainty. What advice would you give to traders in terms of attacking earnings in a time like this?
It's a great question. I think every so often we have this pocket of time where everyone is talking about the same thing. Or when Bitcoin and crypto came out, we had Radio Shack talking about it. We had a coffee roasting company talking about it. Now I think you're going to hear a lot of tariff implications. So there's going to be a lot more heightened implied volatility in that weekly cycle where earnings are. Just doing your due diligence, have an understanding of what might impact the company you're trying to trade and how potential tariffs might impact that.
And what would you say your earnings checklist is? What criteria do you look for in a company if you're going to try to make a play on earnings?
You have to be really small. Even when you have a super strong assumption, you can be really wrong with earnings. The options market's closed when the earnings come out. You can't adjust unless you're hedging with stock, which I would say maybe size down more than you normally would. Stay defined risk. Just because a company reports good earnings numbers doesn't mean the stock is going to go up. Just be prepared for a lot of uncertainty.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, cover calls, iron condors, jade lizards, become a trading mastermind. Get the guide at tastylive.com/guide.
I bought a stock when I was first old enough to open a brokerage account. It went up 1,000% and I made a bunch of money and I was hooked. I felt like I was just pretty much gambling in the markets. I had a big win and it was mostly failures thereafter that. And I thought I need to find a way to consistently pull money out of the markets and find a more consistent, repeatable system. Fast forward, I ran into Tasty Live, really loved the market measures and the data they had behind to back up the research they were doing. My biggest takeaway is that you can find an edge in financial markets. It lies in volatility overstatement, volatility mean reversion, and having solid mechanics.
Calling all traders. Are you using Tasty Live mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, Tasty Live has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Tasty Live's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging, and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
If you don't come from money, working with money sounds like the quickest place to get to money. So this idea of allowing money to work for you was fascinating with me. And then the more I get into it, the more I realize it was just a big competition. You know, it's like a big poker game with really smart people who know game theory and nobody knows tomorrow, but they're all just taking calculated risk. And when I figured out that's what it was, like it wasn't this weird world of like somebody knows exactly what's gonna happen and this guy's got great stock picks, it's all just calculated risk, that gave me inspiration that like, well, I can do that. So I think spending a lot of time when I was young to learn different option strategies and to learn stocks, options, futures, Forex, crypto, to be able to go where the opportunity is, I think is the most important. Getting hooked in a strategy, it's cool, I respect it, but I tend to think I like to go wherever the opportunity is.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
I got Joe. Joe in Houston, what's up?
Just want to call in and say I really appreciate everything. I started trading and learning from you guys about 6 years ago. You know, it was you guys' work and the platform that got someone like me that didn't really know anything about the market capable of really outperforming the market now for, 5 out of the last 6 years. And so just, I really appreciate you guys. I can't think of another company where I can pick up the phone and call the CEO, the trade desk, and reach somebody as quickly as I can there. So just really appreciate everything and what you're doing for guys like me out here. What you're doing is really spectacular. So really appreciate it.
Thank you, my friend.
I really appreciate it.
You made my weekend, man.
All right, Tony, we have a big week of earnings coming ahead in a time of high volatility and uncertainty. How are you choosing to attack this week of earnings, and do you think that there's anything that traders should be aware of?
I think earnings become less important when you have volatility in the overall market, because sometimes a lot easier to find a higher probability trade in a longer dated time frame than you would for earnings. But if you are going to trade earnings, I think you have to trade it much shorter term and probably directional. And with this implied volatility being so high, it's going to be even higher in these earnings trades, which means that all options are going to be priced a lot more fatter. And if they're fatter and you're selling them, then you can get a higher probability of success and be further out. So I think you have to trade them directional, and I think you have to trade them shorter term for earnings themselves if you're using options.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're #1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the tastylive core strategies.
Oh, yeah, it's Monday, May 19th, a little bit after 5 p.m. Central Time. The best time, you know what that means? It's time for Tasty Live's evening show, a little podcast, a little podcast called The Price of Truth, a show where we like to explore the incentives that govern our world. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. If you don't already have both, do yourself a favor and go get them. But if you want to be part of this little guy, there we go. I forgot which finger it was. If you want to be a part of that little guy, the chat box on your screen, there's only one place you can do it, and that's on the evil, and I do mean evil, but potentially underpriced Google YouTube. So head on over to YouTube, subscribe to the channel, and then start moving those phalanges, those metacarpals, or just even bash your skull into the keyboard to create random-ass characters or appropriate or inappropriate thoughts. Whatever it takes to spoof the Google algorithm and put us in front of as many people as possible. Shout out to all of you that are already in the chat. It's so good to see all of you. Honestly, after a long day or early morning, wherever you are in the world, to come in and see all of your bright, shiny, smiling faces. I mean, I don't know. Maybe it's not shiny. Maybe you're not even smiling. Maybe it's not even bright. Maybe you're in a dark room. But the point is, I'm glad to see you. Shout out to Sleepy Mocha. Shout out to Theta, Catan, Mark. Are they running commercials over my face? Mark, Cato Prime, Donna, Sun. Oh, man, we got the whole crew in here. Jay, what's up? Emmett, did I ever say your name? If so, go buy a lottery ticket. Brian Watson, the YouTube goat over there. Edward, Kyle, JDD, scrambled everything. So many more. Shout out to all of you. Great to see you. Off, and away we go, people. End of the world is here. Oh, didn't happen. Again, it didn't happen. But you are getting more bullish, aren't you? It's making you a believer. It's making you a believer. That's how these things work. S&P, my babies, cash, end of the day up 9 basis points. So if you were freaking out last night when the NASDAQ was down 2%, they did the same. They did the same thing. They did, what was that, April 3rd? They bought $4 billion worth of stuff. It's like the same pajama trader. It's all retail. It's like the same pajama traders. You give them a discount. They do this every time. Click. Thank you, sir. May I have another? I'll take $4 billion worth of stock, please. It works until it doesn't. One of these days it's not going to work, but that day is not today. The NASDAQ up 9 basis points. The Dow Jones, my babies, up 32 basis points. This is easily, you all know this is the worst index ever created, right? Sorry, I'm a bit thirsty. I'm parched, as they say in the business. The Russell down 0.2%. So much for that rotation trade, huh? They'll come back tomorrow. But easily the Dow Jones is the worst index ever created. And guess what, my babies? Give me a hip hip. I'm going to imagine you said it in your basement. Some of you need to put some pants on. Give me a hip hip. There we go. That was a little bit better. Better participation that time. The point is, my babies, wouldn't you know it, United Healthcare up 8% today. Now, eventually this thing's going to crater, and we're probably going to trade down to 230. But the point is, for today, you feel good, don't you? It feels good to push the button when everybody else is scared, when you don't really have a reason, when all the smart people are telling you why a stock should go down and everyone's freaking out about a potential investigation, because you knew what I knew, didn't you? You knew that if that investigation gets bad enough, somebody's going to disappear. And as sick and twisted and sort of quasi-satirical as I'm being right now, you know, in the pit of your soul, it's probably true. And so you push the button anyway, and you're up 8%. Congratulations. Grumpy Mike says, what a stupid day. Don't fight it, Grumpy. I'm telling you, the market's right. It's us who's wrong. Don't fight it, my friend. Who? Happy birthday, Nicole. Nicole, at the end of the show, if it is your birthday, I may sing happy birthday to you specifically. We should do a thing. Just come in here and tell me if it's your birthday. The problem is, most of you are going to lie. Most of you are going to lie, and I'm going to be singing happy birthday at the end of every show. Let's talk bonds, my baby. We'll get back to stocks here in just a minute, because I think there's a lot of interesting extremes here as we inch closer and closer to 6,000. And as I said yesterday, I don't know that you have a massive I don't know if you've got a massive upside catalyst here, which sort of makes me think we kind of might be in this slightly right distributed curve here, with not necessarily a fat left tail, but a tail that keeps you honest. I think we could be in a sort of a sideways chop for a little bit to slightly positive. The hardest trade right now is to buy them. I think you can say that very easily. The hardest trade right now is to buy them. And so sort of the greatest irony is the hardest trade is generally the one that tends to work out. I don't know if that's always true. Just anecdotally, I think I believe that. Let me see what's going on here. I knew it. Look at you guys. I knew you were screaming out hooray. Some of you said it. Some of you said it out loud. And I want you to know, if I was at home watching this stream, I would have said it out loud too. Don't feel silly. You know, we just connected in a way through the internet. That's what this thing was supposed to do. It wasn't supposed to be used as a surveillance and tracking device. It was supposed to be used to connect us as humans. And we had a little connection. For those of you who sat idly by and said, I'm not doing this, this is silly, shame on you. You let that 8-year-old that's deep inside of you, you let him or her out. Please sing, says Nicole. Ugh. You'll never come back here again if I start singing. ZB, my baby's 113 and 7 ticks. Huge range on the day. God, they scared the crap out of me this morning. I'm not going to lie to you. This morning, I guess it was my morning. It's not necessarily your morning. But they scared the bejesus out of me. We were down 2 points in bonds. And I'm going to be 100% honest. I didn't even press the button. Yeah, they scared the crap out of me this morning. But they came back. We're at 113. No. That's not true. That's not true. I puked one part of my position. I somehow last Friday had some long bond futures on that I didn't. I was like, where the hell did these come from? So I got rid of those and then replaced them with a bunch of upside call deltas. So it wasn't the worst day. But if we get back to 117, baby, I'm taking you guys back to Sizzler. But that was a hard hold. That was hard to hold them today if you came in long. Shout out to everybody that wasn't holding them or maybe scooped up a little bit. You got a nice 2-point rally in bonds, a massive range on the day. I just think I'm just not scared. You're downgrading. Give me a break. You know what I mean? That was the first thing I thought. The first thing I thought when I saw that headline was like, yeah, welcome to reality. But the problem is when you downgrade the debt, it's like relative to what, man? Relative to what? It is the risk-free asset. You know, so it's like, yeah, okay, you're playing this game, and some people, I don't know if there's any credence to this, right? I don't know if there's any credence to the idea that you've got this big, beautiful bill that's going to be voted on, and all of a sudden you get this downgrade that shows up on Friday to U.S. debt, which then perhaps says, hey, that $3 to $4 trillion you want to add to the deficit, maybe that's not such a good idea, and that allows some Republicans to vote it down. I don't know. I don't know if that was a political move. I could totally see it. I don't think it's conspiratorial to put that on the table. It's oddly timed, but whatever. The point is, does it matter? And if S&P has already downgraded the debt, if Fitch already downgraded it back in 2023, and this is a catch-up downgrade, which one of you does not know by now that we're in a really tough fiscal situation? Which one of you needed the downgrade? None of you need this. You know who needs this? All the Sunday news, Kristen Welker over at NBC News. She needs this so that she can sit down with the Treasury Secretary and just pretend like the world is ending every Sunday. That's who needs the Moodys downgrade. Because Andy Constant made a really good point. Maybe I'll bring up his tweet. He made a really good point about this, which is, okay, imagine the first thing you want to say is, okay, but some institutions can't hold anything less than a certain rating, can't hold anything less than AAA rating. And his point was like, yeah, okay, they're going to change the rules to be able to hold U.S. debt. Do you think all these institutions now deem U.S. risk too risky to hold and are going to pitch it all? So, like, at the end of the day, sometimes I wish I got more worried than I did, because one of these days it's gonna burn me not getting worried on some of this stuff. I'm hoping I'm gonna get worried at the right things. See if I can find it. I should have found it first. Let me come back. But I just think I'm more worried about what happens with the bill. You know what I mean? Debt downgrade. Give me a break. Bro. Come on, people. We're smarter than this, right? We understand our own fiscal situation. I mean, this show launched in March of last year, and I think that was the very first episode with Jim Garcon. The very first episode a year and a half ago. Anyways, let's continue. One of these days it will matter. That day is not yet today, and I don't know. I think maybe I'm getting too cute here. And on the Sunday show, when I'm long bonds, Tom is long bonds, Pete is long bonds, and Ilya is long bonds, and all four for different reasons. Some part of me was like, and this is no disrespect to them, because in one way, if there's any other three groups of people I want to have a similar opinion to, it's those three. It has nothing to do with that. It has more to do with just the positioning of the market. If all of us are long, it makes me nervous because the market's job is to ruin the consensus, right? It's like Vegas when they make a line. Who does Vegas want to win? The money, the betting side of that market, or they want the house to win? That's sort of the job of the market. So I get a little bit nervous, but I still think it's the right play. I totally think the market could catch everybody off sides here, being complacent at 112, thinking, I'm at the bottom of the range, and you start to get some people that get a little bit too long here, and you ruin them. But I at some level, I do think today's action was a bit constructive. Let me say it like this. I think it's constructive. So yeah, I like the long end of the curve here, and you're not supposed to. I don't think you're supposed to like them here. I think as the market moves away from the recession call, I think as they start liking individual stocks and start talking about a broadening out of the rally and start getting more optimistic about trade discussions and geopolitical affairs, as that happens, you're supposed to start pricing more growth and inflation into the curve. And so what could happen is the long end starts lifting, but people don't get as concerned. They're going, the long end is lifting, but stocks aren't going down. Why is that happening? And you're going, the market's going well because we're pricing growth and inflation. But at some level, I could see that happening. It wouldn't surprise me, which is why I wanted to stay risk defined. I have no idea how I got long futures on, but I wanted to stay risk defined with just with bond futures options here. Because some part of me thinks the opposite. Some part of me thinks the flattener's in play right now, and it's already flattened by 20 basis points from 67 basis points 3-4 weeks ago, now down into the 45 basis point range. I think less and less. I think the stronger the data is, the more risk appetite there is, the less cuts you can price, the less cuts you can price, the higher the short end yields go. The higher the short end yields go, the more attractive longer end yields are, in addition to making these deals and easing geopolitical tensions here and sort of trade flows being known and understood by the world. I think that makes U.S. financial assets not as attractive as perhaps before Liberation Day, but at least there's certainty with money flows, global money flows. I think that's generally net positive. It's just the biggest question mark is how much funny money are we going to make? I don't know the answer. There we go. I was looking for this for like the last 2 minutes. Our probabilities of a cut starting in September are starting to firm up a bit. Market's at 93% that the cutting will resume in September, with another one followed in December. Now at 2. We're starting to get to the point. If they would take one more out, if they would just take one more out, if we go from 2 cuts and back into like 1, we would get to a really interesting place to have the over-under discussion again. If we can get back to 1 cut, if they can take one more out of these, we get to only 25 bases. I don't think that's going to happen anytime soon. But if they can take one more out, and we can get to 25 basis points price in from now until December, the narrative's going to be hilarious relative to what it was on April, like, what was that, 7th, 8th, 9th? It's going to be hilarious how far people will pivot. You know that scene in Men in Black? A pinnacle of cinema. You know that scene in Men in Black where Tommy Lee Jones is sitting down with Will Smith on a bench, and he says something to the effect he said, a person is smart. People are dumb, panicky animals, and you know it. I mean, that movie came out when I was probably like 10, 11 years old, something like that. I never forgot that line. I think that's one of the most, it's not exactly like classical cinema, but that's one of the sickest lines I have ever heard related to markets. And I know it's not necessarily a trading movie, but that's one of the most gangster lines of all time. A person is smart, but people are dumb, panicky animals. And you, there's one more part in there, but I can't remember. And you know it. We are, man. But anyways, let's see. I don't think there's anything to be done here in the 2s. I closed that out because I didn't think the risk and reward made sense to just try to squeeze out another. I don't know what this would be, but I do think if we can get back to like just the market pricing one cut for the end of the year, I think we have that over-under discussion, and I think it might be time to start betting the other way. But for now, I think it stays intact, and I still like the long end for a little bit of a rally here. Who knows? We'll see what happens. I might be wearing this like a big old idiot. We'll be down at 109 in the bonds, and stocks will be at 6,200, and people will say you're an idiot. That could happen. That's the game. All right. I'm so sorry. I've barely engaged with the chat. My sincere apologies. Let's see what you guys got. Let me see if I can find it. McNutty says, adding to my long bonds this morning, underwater, but not scurred. Good luck to you, McNutty. We're probably all on the same side of the boat, which makes me so nervous. I so love it when I come in here and I have some point of view and everyone goes, you're an idiot. Are you out of your mind? I'm way more comfortable when that happens. But everyone's like, yeah, me too. I'm like, oh no. Cato Prime says one of the most hated rallies. I totally agree, Cato. I totally agree, which is why it goes longer and farther than people expect, myself included. I think, again, one of the hardest, sickest calls this morning is to go buy them here, right? Because you're top end of the range, you're overextended, you're thinking to yourself, this can't go any higher. Let them come down, let them cool down 5 to 7% from here. And some of you guys are just, you got ice in your veins. You come in and you go, I'm buying 0 TTEs today. I got rent to pay, bro. I got bills, son. Grumpy Mike says the House Committee on Rules is scheduled to hold a meeting on May 19th at 1 a.m. Eastern Time. The meeting will be held in H313. The Capitol will focus on emergency measures, yada, yada, yada. Thank you for that one. Grumpy Mike says nothing unusual about that. Yeah, the passing of the bill at 1 a.m. when everybody's asleep. Wonder what items are in there that they don't want anyone to report. Negative yields. Here we come. Deficit schmeficit. Eventually, right? This is all a shell game, and we all know it. It's all just a big shell game. How many of you have read Neil Howe's The Fourth Turning, or Ray Dalio's Principles for Dealing with a Changing World Order? I think it's a mouthful of a title, but I think it's something like that. Neil Howe just did a really, really great podcast. First and foremost, that book is incredible. I think he wrote it in the early 90s or something like that. And he talks about the social change that would occur after the 2024 election. It's wild. It's so insane. So to read that book and know that it was written in the 90s, absolutely insane. Anyways, Neil Howe just did a really great podcast the other day. I don't think I posted it. I'll post it on my Twitter feed. So if you're curious about content, particular sort of social cycles that line up with debt cycles, I'll post something at Victor Jones. The Owen Jones is 0 because I like to be difficult. I'll post it later today. Lone says, I can't comprehend. Donna says, when everyone agrees the trade is already over with. Lone says, I can't comprehend why some people think like this. Like what? Did I miss something here? 1 out of every 7 USD goes to pay down debt. I don't think that's true. 1 out of every 7 USD, or 1 out of every $7 collected by the U.S. government for revenue in a tax year. Is that what you mean? I think that's what you mean. But I don't even think that's the case. What do we take in? 5 trillion? We spend 7 trillion? And we pay $1 trillion in interest. So isn't it somewhere in the ballpark of 1 out of every $5 the government collects in tax revenue? But maybe that doesn't include corporate taxes. Anyways, the point is, I get what you're saying, Catan, and it's wild. It only goes up. I'll get a couple more and then we'll keep cruising here. JDD says, I'm leaving bonds in my retirement portfolio, not trading them anymore. Yeah, man, I'm not mad at that. I'm not mad at that at all. I think the reason I talk about them so much is not, I pay attention to them, and anything I pay attention to, so long as it's liquid and tradable, I'm going to trade it. I'm just a degenerate in that way. You know, if I like UFC, I like boxing, you know, I watch political outcomes. I like the macro. I like studying macro. So I bet it all. If I study it, I'm just got a weird thing. I'm going to bet it. I'm going to bet my opinion because I'm so opinionated. But I understand. I don't think you need to trade bonds or interest rates. I do think more people would benefit by having an understanding of the debt market. Yeah, if there's one thing that I would wish upon, sort of maybe if I had a short wish list of younger students, it would probably be that, one, we teach kids at a younger age, we teach them game theory. 2 would be debt markets, understanding interest rates and the cost of money, and the history of money. And the third is cognitive bias. I said something like this on Twitter the other day, which is, man, I think I saw this video that they used to show in high schools in the late 40s. I think it was made in 1948, and it was all about how to think about propaganda. It was mostly designed so that a high schooler had some sort of sense for how politics and how politicians speak and how to parse propaganda from political speak, mostly in campaign rhetoric. It's fascinating to watch this and know that they showed this to high schoolers in the late 40s and early 50s. And I think about all the cognitive bias tricks that I see, whether it's like social media, whether it's like on the news, it doesn't matter, pick your channel. I've said this before a couple of times on this show, but like the easiest example to show is like, have you ever seen a panel on the news? I'll give an example, okay? I'll give an example of a trick, and both sides do this. Here's what they do. Let's say you do an interview, right? You do an interview with some person, and the interview is over, and then they go to a panel to discuss the interview. Right there, that's a cognitive bias trick. What's about to happen is something called anchoring. What this means is the first piece of information you get, you're likely to over-rotate into or anchor your opinion into the first thing you hear. So whether you're on CNN or you're on Fox, the perspective you're going to get after an interview or after a major piece of news is announced is likely going to be the opinion that you adopt. So right away, doing the panel after they show this stuff is a method of anchoring, which is a cognitive bias. Furthermore, the number of people that'll be on these shows, it's always an odd number. It's always like 5. It used to be 3, but now like they need more action because we have ADD brains. So now they have 5. One of them is usually is there for the illusion of fairness to present the other side. Then there are 4 that have the opposite opinion. That's something called the bandwagon effect or herd. So what you do is you hear 4 people with one opinion and one with the opposite. You're like, well, our human monkey brains go, well, it must be the 4 who are correct. So you're anchoring in the first opinion you hear, and you're likely to believe that because 4 believe this one thing and 1 believes the other, that the 4 must be true. And they do it all day long, 24/7. Then they throw it in your feed. And now all the clips that you see do the exact same thing, and you only see clips that you're likely to agree with. That's something called confirmation bias. So we're like locked in this world. We're locked in this world of all these cognitive bias working against us to try to make us either on purpose or just accidentally, because the incentive structure, that's what's there. And if you do not understand this, if you don't see the world through the lens of the incentives and to hack your brain for somebody else's benefit, to hack the weakness in your own human nature, then what chance do you have? Why would we not be teaching high school kids that or middle school kids that? You don't teach them that because it's not in their benefit. I don't know, maybe we just don't understand how important it would be. But anyways, if I had my small wish list, that's what I would pray that we start teaching kids. Game theory, debt and the history of money, and cognitive bias. I think we did that. That's a pretty decent start. Sorry, that was a tangent. McNutty says, I'm way too long right now chasing the momentum with all the bearish fund managers. Go get it, McNutty. Go get it, man. I'm not mad. I just told you guys, I'm not the guy. When the momentum trade is here and you're just supposed to stay long until the short-term moving average crosses below the short-term moving average or whatever that stuff is, I'm not that guy, man. That stuff is not interesting to me. But I'm not mad at anyone who gets it. I'm just the guy who shows up when you're scared. I take a puff of my cigarette and say, "You're scared, aren't you?" I don't think you should be. Flick the cigarette and go, "I'll buy them." Or the opposite. It's like, you're pretty confident. You feel really good about the future right now, don't you? I think you should be more scared than you are. But here you go. I'll sell them to you. I'm that guy. I'm just kidding. I'm the guy getting whipped around by the markets. Trying to pretend like I'm some big shot. Still waiting for those dollars from Reaganomics to trickle down into my wallet. Says Emmett Morrison. Oh, you are the GOAT, Emmett. That's pretty funny. JDD says, that would be a great requirement for a high school diploma. I totally agree, man. And you know what? One more thing while we're on the topic. Because there's this movement to teach financial literacy in high schools. And, one of my buddies got tapped on the shoulder to help to collaborate on what that program would look like in New York City. And he sort of asked me some questions early on and what I thought about the whole thing. And I said, I couldn't be a part of that group. He said, why not? And I said, because I know the game too much, and I don't think they're actually trying to help anybody. At least I would be highly skeptical, and I'd be kicking and screaming at every meeting. And he said, why? And I go, because I don't think that even the people who are putting together this program understand what it means to be financially literate. I said, what are you going to teach kids? How to read their credit score? You're going to teach them how to read the ridiculous APR on their credit cards? You're going to teach them, simple things like appreciating assets versus depreciating assets. Is that what you're going to teach them? Because I think that's just making a slightly better debt slave. And he goes, Jesus, Victor. And I said, I'm serious. I said, if you really care, if you are really going to design a financial literacy program for kids, they wouldn't let you do it. Because you would be teaching them how not to be just a straight consumer. You'd be teaching them to minimize their debt and only take out debt to actually purchase assets. You'd be teaching them about positive and negative carry. You'd be teaching them about game theory. You'd be sitting them down. You know what? I think I said, you would be better off teaching kids poker than what this program is likely going to end up being. You'd be better off teaching those kids to play cards. Teaching them how to think about risk and reward, teaching them about sort of game theory and the play behind poker. I think that has crossover. It helps them in decision making, and I think teaching people how to read a credit card statement and then checking the box, making administrators feel good, like they're creating financially literate high school students. I think nobody's going to end up winning. And I said, you got to push. You got to push for real education. You got to push for something a 16-year-old actually needs, a perspective that they're not going to get. Not just somebody who can not go bankrupt. Take out as much possible debt, but avoid bankruptcy. If that's the goal, this is a bad program from the outset. Brian says, go out there and buy something, Victor. Exactly. The future seems more like idiocracy to me. I want to be, I actually want to be, Victor's drinking our milkshakes. I want to be more positive about the future. Because here's what happens. The reason why Neil Howe's fourth turning, the reason why there are these cycles, it's because of generations, right? It's like that saying, what is that saying? Hard men make soft times and soft men make hard times. Did I get that right? Hard men make soft times, soft men make hard times. Something to that extent. So it's like, at some level, all the things that I think are important, I'm going to imprint into my children, right? They're going to know that stuff, which then creates a whole different mentality a few generations out. And I'm sort of praying that that's what's going to happen here. That all of our generation woke up. We saw the game for what it was. We saw politics for what it was. We saw money for what it was. We saw assets versus consumption for what it was. And so the offspring of that generation has a completely different mindset because of what they're ultimately taught. Catan, he's going to sing later. I think I unknowingly and somehow created some like reason to stay to the end. Let's see. Mark says these tariffs, taxes will not offset the cost between the U.S. and Chinese labor. They're nothing but a consumer tax to raise revenues to pay for wealthy tax cuts. I agree with almost everything you said, except the framing. I agree with almost everything except the framing. I think the framing of cutting, like paying for wealthy tax cuts, I see it as, and mind you, everybody that watches this stream, they know how I feel about the wealth tax, okay? They know how I feel about, you know how I feel about the wealth tax. I think the tax cuts, you're going to hate, some of you are going to hate me for saying this, but this is the way that I think about it. This is the way so politics is all about a negotiation, right? Especially if you're a populist leader or a faux populist leader, whatever you want to call them. It's a negotiation between capital and labor. So a politician is negotiating one thing for another. And I think the tariffs, I 100% agree that money is not going to offset the tax cut. I think the tax cut enables margin expansion, which is an offset to some policies that create margin contraction. And so it's like if I'm negotiating between these two counterparties, and I want more jobs for this group of people, I want to create more incentives like no tax on Social Security, no tax on tips, all that stuff, right? If I want to give more to this group of people, I got to give the other side something. And I think the tax cuts are an offset. That's the way I've always seen it. It's like kind of like this. It's not like a bribe, but if I don't do that and you get margin contraction, what's going to happen is, a shareholder, a CEO of a company, and a board is going to say, well, how can we protect that contraction, especially in an era where we have all of this productivity and AI and robotics that we can utilize to expand our margins. And so I think you end up with just straight populist policies, you end up with higher unemployment. And the tax cuts in the very short term are sort of this offset to that real potential of margin contraction. I'm not here to speak to whether that's good policy, bad policy. All I see politicians as people that are lining up things on one side to go to labor and things on the other side to go to capital. And you can make the argument that one side's getting more or one side's getting less or one side shouldn't get these certain things. But I think people kind of get locked in this world where only giving to one side is what you should be doing. And I don't know, maybe you make the argument that capital has had their fingers on the levers of power. It's probably it's time to give a lot more back to the labor class. You can make that argument. But that's probably speaking to a world you want to see and not the world as it is. And the world as it is a negotiated settlement between labor and capital, and the policies are just lining up who gets what. And so that's what I see it. It gets framed as tax cuts for the wealthy to pay off his rich friends and his donors. That's how it's framed. And maybe there's truth to that, but I think it's all, this is all a negotiated settlement. And so me as an objective observer, I just go, okay, you put that's coming over here to pay for, well, what's over here? I'll move on. I think if I do a good job being neutral, most people don't like me. Most people don't like what I have to say. I'll piss off everybody. Yeah, so that's the weirdest place to be. And it's also where you have the most, I'm not going to say alpha, but like you get the most contra. If you say something that people hate, like your market position, you're probably on the side that has the highest payout potential. So it's weird. Saying the thing that the most people hate most of the time is the most beneficial and likely mostly true. But living that life, horrific. Saying things that people constantly hate. All right, let's keep moving. Sorry, I got locked in that was a 40-minute weave to use the term. 40-minute weave. This is one. I would love to see this thing rally again and fade it. We got a little bit of a rally here today. I don't know what's up with me lately. I don't know what's up with me, but I like the currency trade. I like the very short-term long dollar trade. It might already be over, that little 2-week period might have been it. But I like it a little bit. It's the same reason I like bonds. Same reason I kind of like the flattener. Kind of the same reason I'm getting neutral on risk, or have been. It's all the same. Bitcoin at 105. Excuse me, what's up with me? Bitcoin at 105, nearing the highs. Let's play the over-under. Let's play the over-under game. Give me the month that Bitcoin makes new highs. Maybe we should do weeks. We should probably do weeks. Weeks until, that's probably better. Weeks until Bitcoin makes a new all-time high. We're about 4,000 away. There's a built-in assumption here that we do make all-time highs, so it's possible that we do not. If that's your bet, just call it 0 or infinite, I suppose. Let's call it 0 for now. Number of weeks until Bitcoin makes a new all-time high. And the over-under is 2. You take the over, the under, the push. What say you? I think we're going to be at new all-time highs in the next 2 weeks. I loved everything about today's move. I almost feel like you can't dump them. You can't, even if the market does roll over, you can't roll them until Bitcoin makes a new high. Bitcoin making a new time high is like the foghorn for the markets. If you want everybody to capitulate and go buy risk, you You pump Bitcoin to a new all-time high. Boom! It gets in it's in everybody's feeds. People come back, start betting on risk. Now you roll them. You can't roll them till you get a new all-time high in Bitcoin. I've loved everything about the way that it held in through a period of volatility and its performance, the narrative, the legislation. You know, Brian, what's his name? Brian Armstrong has been in Washington for the last couple of days, has he not? Working on Bitcoin crypto legislation. How gangster, by the way. I never talked to you guys about this. The Bitcoin hack. If you didn't see, Bitcoin is hacked. I think they basically used some form of social engineering. I think they bribed some people that work at Coinbase. It sounded like maybe some parts of their business they've sort of outsourced to maybe some other country, maybe. And somebody bribed those people for access for personally identifying information for PII. I don't know the whole details of the story. I'm sure I'm just telling some parts of the story wrong, but this is the gist of it. And they wanted $20 million. They threatened to sort of expose their customer data. And I don't know if you've ever seen the movie Ransom with Mel Gibson. But there's this part in Ransom where he's supposed to give, I think it's like $1 million or something like that, because back then that was a lot of money. I mean, it is a lot of money today, but let's face it, it's not the same. So I think it's something to the extent of he's supposed to pay $1 million, and he has a press conference where he's supposed to announce this or something like that. And then he basically says, I'm not going to give you this $1 million. You'll never touch a penny of this. Instead, I'm going to give this $1 million to anyone who turns in my son or turns you in. So it's like it was a mechanism to turn this group of people who kidnapped his son against each other. It's a really fun. I mean, it's not funny, but. And then that's exactly like I think Brian Armstrong saw that movie, and that's exactly what he did. So he made this video. He posted it on his Twitter, on his social feeds, and he basically says, "You're never going to get a penny of that $20 million. Instead, I'm giving it to whoever turns you in." And I mean, it's not funny, and I thought it was gangster that he did it, but some part of me chuckled a little bit because it's a scene straight out of a movie. Sometimes art imitates life, sometimes life imitates art. But good on him, man. That takes courage. I think he did the right thing. I think he showed a lot of leadership, incredible leadership skills in that moment. And I think he was transparent about what was happening. I thought it was a good move in all ways. And I watched that video to speak to that study that was done that said retail traders spend less than 6 minutes on a trade idea. Here's what it took. I watched that video and I go, I'm going to buy some Coinbase. I think I got a little bit of upside deltas that day just because I watched his ransom video. If you love this concept of ransom videos, then you got to go watch you got to watch The Office, where Michael does a ransom video. That's pretty funny too. What did you guys say in the over-under? Even Jamie Dimon may be getting on the BTC for customers' angle. I don't get what his deal is. I mean, I kind of do, right? It's like everyone says, no, that's a Ponzi scheme. So you should be trusting this Ponzi scheme because I have power and control in this Ponzi scheme. Don't go to that Ponzi scheme. I have no say in what happens, or I have less say. But in a way, I think as soon as they did this Bitcoin ETF, I think whatever Bitcoin could have been was compromised. Whatever it could have been was totally compromised, in my opinion. And I don't like the same thing they say happens with gold and silver, which was enabled by GLD and so, like all the paper markets, the paper aspects of gold. That there are so many more receipts or claims on gold than actual physical gold. I don't know why people don't think that exact same thing isn't going to happen in Bitcoin, or you at least opened up the attack vector for that to happen. But hey, if it pumps your bags, who cares? That's somebody else's problem. We went from save the world to pump my bags. Funny how that happens, man. Rational self-interest. Rational self-interest. That's the mechanism of control. You know what I mean? If I know your rational self-interest, I just change the incentive structure to dictate your behavior. That's the whole lesson in Prisoner's Dilemma. It isn't don't rat on your friends. The lesson is, and it's not how to optimize your play. The lesson is the structure of the game can be controlled as long as I know your incentive structure. I control you. But if you care more about loyalty to your friends, if you care more about the people you're with than your own individual self-interest, it's harder to control you. And ironically, that's where your best outcome comes. Work as a team, but socialism is bad. All right, let's keep cruising. Gold at 32 and change, they just won't break it, man. It's the same thing that happened like around 26. It just wouldn't, it was like we could not go down further than 2,600. And at some level, let me show you what I mean. Let's go to the continuous contract. It's like, it's like somebody was just sitting here and they would not let this thing break 26. And at that time, I was like, if we get below 2,500, it might be a good entry. And they just wouldn't let them break 26. And at some level right now, 32 is like this little line that we haven't. I'd love to see him break 32. I'd love to see him get back down to 3,000. And in a way, the miners seem to have priced that already. The miners gave up hope. GDX is down from 54 down to 47. Newmont got absolutely clobbered last week. But if you remember, some little birdie said to collar up those gains. I'll feed you, my babies. So we got out of the way a little bit of that. But, you can make an argument here if you are a longer-term bull in the miners like I am, that you gave you a decent price here. I think if gold can break 32 and gets back down to 3,000, miners they'll have a little bit further to fall. But I kind of like them here. I wish they'd crush gold. I really wish they would just crush it. I wish they would crush gold down to 3,000. I wish Bitcoin would be at 120,000. I wish it would be at like 6,100 in the S&P. I wish vol would be down at like 16 and change. And then we can just start buying up some cheap puts and get ready for that 5% puke. Because everyone's still skittish. They want to get bullish, but they're still skittish. And the moment they run that headline that says, China and the U.S. discussions are falling apart or getting more aggressive or further away from the deal, the moment they run that headline, everybody runs for the hills again. What do we actually have right now? A deal in principle? I think Besson even today, he made some mention that if our trading partners are unwilling to negotiate, that tariffs could go higher. I think he said something to that effect today. I would not be surprised, man. But maybe, I think you almost can't bet on that. You know what I mean? Because if it happens, you're not going to know when it's going to happen or why it's going to happen. I think the more important thing is to just be prepared, have the risk you want on, so that should something like that show up, you can properly frame it. Okay, I had this in my, I planned out the distribution. I have my left tail risk, I have my right tail risks. All of these are sort of like known risks in the market. And when they show up, I sort of had a feeling this could happen. This is how I would think about the world in that, if that were to be true. What is happening now? Does it match what I thought could happen? I think it sort of helps to frame things. You know, why would you be afraid? There's no room for fear when you've sort of thought through your left tail and right tail distribution risks. So when the world manifests themselves that you've already sort of thought through, there's no room for fear. It's just execution at that point, given what you see on the screen relative to what you thought would happen. Give me back my son. Soul Train. Okay, let's do this. Who can tell me the lead? So there's a guy in there. He was both the cop and the engineer of the kidnapping. Don't Google it, okay? No Series, no Groks, no AI. Let's get these synapses in our brains working. Who can tell me the name of that guy? The name of that actor? Let's see how good you guys are. What do I think about Netflix and Disney? I honestly, I completely miss the Netflix trade. I don't get it. I honestly do not get it. I mean, I sort of get that they'll get a lot more money from their advertising tier. I get that. And I think people are starting to think about Netflix as sort of like a defensive stock. This thing that I heard Josh Brown say this the other day. I don't know if I believe it. I think he's a really smart guy. That I think the way he's thinking about it is right. I don't know if it's the right way to think about it. I'll explain what I mean. He called these stocks like defensive. He said in a downturn, in a recession, people aren't going to stop buying iPhones. People aren't going to cancel their Netflix subscriptions. People aren't going to stop being on social media. And I think he's right that people think that. I don't think that is true. I think if you're in a downturn in the economy, or the broader economy starts to look like what it looks like for the bottom side of the K, is probably a better way to say this, because I think some people are living a recession right now, and they've been in one arguably since like the third or fourth quarter of last year. But I think then one job becomes two jobs becomes three jobs. And what happens to your time on social media? Does it go up or does it go down? If you're working two jobs to make ends meet, do you buy a new iPhone or are you buying used iPhones? And if you're buying a used iPhone, is that benefiting Apple? If you're not paying $1,000 a pop or $20 a month or whatever that thing is, if instead you're buying used goods, which I think, a higher percentage of these types of purchases would go towards buying up used products versus new ones. Are you going to spend a few hours on Netflix? Are you going to spend a few hours on Netflix? You're more likely to cancel a Netflix subscription to save $20 a month, or whatever the price is now. I don't know. I don't have a subscription. So I wouldn't think about these things as defensive. I totally think that there are some cyclical elements to those stocks. I do think that they're maybe not the same as other cyclicals. And I think that he would probably say that as well. He's like, bro, I'm not telling you that those stocks are going to hold, like they're not going to go down in a recession. He would probably is just saying they're less cyclical than, I think he used an example in the past of like Alcoa. It's not that type of cyclical, or doesn't have that type of beta to the actual real economy, which I would agree with. So I think from a trading point of view, I would look at this and go, yeah, I'd fire against this for sure. I would want to fade this. I don't look at it. I don't have a feel for this market at all. And I don't usually love to come in and short things that I haven't been watching at all. Unless something goes super, super dumb. I've mentioned this many times on this podcast before, but like Rivian, when they made 10,000 cars, but were trading with a market cap that was more than Volvo, which made millions of cars in a year. I go, okay, this is stupid. And I didn't have to have a feel for that market to go, this is stupid. You just have to stand in front of this long enough, and then it eventually all came apart. So I don't know. I haven't been watching this. I wouldn't fade it. I don't know what the deal is here. But if you put a gun to my head and you said long or short, I go short for sure. And it's hard for me to wrap my mind around the fact that, like, why are people buying this stock? I don't even know why people subscribe to Netflix. So I might be the worst person to ask about Netflix. I don't even have a subscription anymore. I'm telling you, it's nearly impossible. I will say this for myself. I've made it really hard for advertisers to find me. I pay for YouTube Premium, so I don't watch any ads on YouTube. I'm not on Netflix. I don't own a TV. I don't listen to the radio. I don't listen to Spotify. When I have music, I buy the album. And so when I listen to music, I'm literally playing the album. That's the way you're supposed to listen to music, everybody. See, that's what you young kids, I'm such an old guy now. That's what you young kids will never understand. Putting in a CD or a tape and you listen to it all the way through as the artist intended. They wanted to take you through sort of this emotional journey. The good ones did anyway. You know, you'll never know that feeling of when a song ends, you already know the beat that's about to hit. You'll never know what it's like to listen to a song, like it comes on the radio or something like this, or you don't know what the radio is. To listen to a song and then you know what the next song is supposed to be because you've listened to that album so many times that once you get to the end of a song, you have this Pavlovian response that wants to move into the next song. There's probably a word for that. I should grok that later. You'll never know what that's about, but I still do that. I still listen to albums start to finish. So you can't put an advertisement in when I'm listening to music. So, you know, they're reading my phone and my emails and my texts and my searches and all that. But other than that, it's kind of hard to find me. So like movies that are coming out, I have no idea. Absolutely no idea. Games that are being played, no idea. Like award shows and all this, I have no idea. Absolutely zero idea these things are happening until after they happen. All right, we'll do a couple more here. Lawrence says, I just paid $8.99 to add a household to my account, and I hate myself for it. I hear you. Greedy, you know what? You're part of the problem, Lawrence. You're part of why I'm looking at this Netflix chart scratching my head. People like you adding households. You paid for a service and they made you add a household. Can you believe that? Imagine if newspapers did that. We're going to send you the newspaper, but if you give that newspaper to your friend, you need to pay us again. F you. I pay you for the service. See, that's the thing, man. If we were this is the game, bro. The more you digitize something, the more control somebody else has. Do you understand this? You remember when Netflix was mailing you a physical CD, do you think they would be able to monetize you giving that physical CD to DVD for somebody else to watch? No, they couldn't do it. But when you digitize it, you get a benefit, which is more, more convenience, but they get more control. And guess what else? Guess what that is analogous to? It's probably not the right way to say that. Money, bro. Money. You guys better hold on to physical currency as long as possible. You will rue the day that you jump in with 2 feet to CBDCs. You will rue that day, my friend. You don't want it. That's why I have physical books. I started thinking about everything in my life, and I said, all right, what is it that I keep digitally that somebody else has, and that technically means they control? I thought about everything. I go, well, all my photos, I don't actually have those. Technically, they're in a cloud somewhere that's in somebody else's servers or on somebody else's server phone. I don't have those. Those could disappear one day. I said, my money, I don't have my money. It's at some other place. I was like, my books, they're all digital. I don't own any of those technically. Even the stocks I own, I go, they're held in street name. Those aren't even held in my own name. Worst case scenario, I got a big problem there. I thought about everything in my life, and I tried to understand, what do I actually have? And the answer to most of those things is nothing. So that's why when I think about like the Klaus Schwab line, you'll own nothing and be happy, and sort of this, I think people have this idea that that's out into the future. That owning nothing means assets. You won't own your house. You'll have to rent it from the rentier class or something like this. You won't own a car. You'll get picked up by a self-driving Tesla. There's probably some truth to that aspect. Like there's these bigger things that we could be on our way to moving towards. But I'm like, most people don't even understand that they don't own most stuff anyway. Even your house, technically, I guess you're on the deed, but like the mortgage sort of supersedes ownership. So do you really own it if you've got a mortgage, if you haven't paid it off? And if you don't own it in a trust or something that can't be garnished? I think when I heard that line and I see people talk about that line, I'm like, bro, you're 85% there and you don't even know it. You're 85% of the way there, and you don't even like cognitively understand that you don't actually have anything. Somebody else has it all. McNutty says, paranoid much? Maybe. I don't think I'm paranoid, I don't think the end of the world is coming. But I think that's just the way my mind works, man. I just think through risks in all parts and all facets. And so it changes my behavior. So then some part of me was like, okay, I would like to diversify some of this risk. So some of the money I took out of the bank at that time, I bought more physical gold, more physical silver. I bought more Bitcoin, things that I actually had. And then I bought all physical books. I have a big physical book library now in my house versus the digital one that I kept before, because the ownership to me was more important than the convenience of having it on an iPad stored in the cloud somewhere. It also pissed me off that I'm like, what's the marginal cost? If you create one digital book, it's the same cost. So like, if I'm gonna buy a book, why wouldn't I actually pay for the cost of production to have a physical product versus a thing that had almost no marginal cost? Like, I'm gonna pay the money, give me something for it. Don't give me a digital bit that it didn't cost you any money, This is a wild show today. What a weird show. I just ranted for 80 minutes. Just look out the window. If no meteor in sight, you're good. I agree. I'm not I don't think I'm a doomsday person. When you get on here, does it seem like I'm angling towards the end of the world or end of day scenario? I don't think so. I think I'm just trying to see the world as clearly and objectively as possible. I'm going to leave you with this one before I sing happy birthday to Nicole and get everybody out of here. I kind of want to spark a debate here. I don't know how much you guys are going to engage. My wife and I don't really do the Santa thing with our kids. I started for the first 2 years, and then I said to my wife, I don't want to do the Santa thing anymore. I don't want to tell them that there isn't one, but I just want to quietly not do it, and I don't want to mention Santa Claus anymore around Christmas. She goes, what are you talking about? She has to live with me. She has to deal with these crazy, you know what I mean? She has to deal with this. She goes, what are you talking about? I said, well, I don't ever want to lie to my kids about anything. I don't want to create a false reality for them that then gets shattered later. I want them to be anchored in the real world with a real sense of what life is, not sort of this fantastical thing that's not true. It has to be there. So then their whole life view gets shattered, and they have to rebuild on top of this idea that all of society lied to them for the first 9 years of their lives, including the people that they loved the most. And bro, I'm insane. I'm batshit crazy. Anyways, so she was like, I don't think she totally agreed, but she grew up in Singapore, and Christmas isn't a big thing out here. So she was like, all right, whatever, whatever. This is more your tradition than mine. So we really don't do it that much. And I'm sort of curious what you guys think about that. Again, I'm not a monster. I didn't go to the kids and say there's no Santa Claus, but we kind of phased it out. We don't talk about that aspect of Christmas at all. And it's for the reason that I don't want to lie to our kids ever. And I want them to be rooted, have a strong sense of reality. Am I wrong or right for this? Hopefully I see the chat starting to move. Somebody goes, Santa's not real. Let's see what happens. Oh, look at Victoria. Santa ruined your worldview. No, that's not what I'm saying, McNutty. You're taking everything I say to like a massive extreme. I know. That's Kyle says the saddest kid in 5th grade was the one who was the one who believed in Santa. 5th grade. You made it to 5th grade, Kyle? That's tough to do. That's got to be super tough to do today. I'm going to read all your comments. All right, let's do this. Nicole, all right, everybody, do me this favor. Let's use the internet the way it was supposed to be used. Let's connect with each other on a human level. We've got a birthday in the chat. Let's do something we've never done here, which is I'm going to sing one verse, not the whole thing. But let's connect with Nicole. Don't be some too cool for school person looking on your phone or your tablet or your desktop and say, I'm not going to do this. Just do it. Connect with all of us as human beings in this moment through the internet. Nicole, this one is for you, my friend. Happy birthday to you. Happy birthday to you. Happy birthday, dear Nicole. Happy birthday to you. Nicole, have a good one. Just don't clip that and put that on the internet, everybody, okay? Let me get out of here with some pride. And shout out to all of you who actually sang. That was a cool moment. I'll see you back here tomorrow, everybody. Same time, same place, same great network. Only on Tasty Live. Peace.